Good morning, everybody. And after yesterday's closure due to another snow day, I think I'm going to have kids going to school until July, the way it's going. We're really glad you were able to come today to lend your expertise to this discussion about risk management practices by commodity pool operators. My name is Gary Barnett. I'm the Director of the Division of Swap Dealer and Intermediary Oversight, or DSIO. That's the CFTC's operating division that has oversight responsibility for CPOs and CTAs. My colleague?
I'm Amanda O'Lear. I'm the person that most of you spoke to on the phone. I am an Associate Director in DSIO, and my team's primary responsibility is the regulation of CPOs and CTAs.
Great. And we know from our discussions with industry participants that risk management is becoming an increasingly important topic for investors and managers, and that risk management practices are being implemented and are developing. So we look forward to hearing from you and from these industry experts about the current status of the market in terms of risk management by funds or commodity pool operators. Before we can get started with the core principal topic today, let's cover a few housekeeping items. First, the schedule and the agenda. The first part, let's make sure our cell phones and Blackberries are on vibrate, take calls from outside the doors. Sound travels pretty well in this room. The bathrooms are all the way in the back. I ran into somebody headed there earlier. You go out, you go to the back, and it's all the way in the back. If you stop before in the kitchen area, you'll think it's not there. Anyway, you go all the way to the back and then turn left. Our schedule today contemplates 3 sessions. The first one, we're going to start right away, and we'll be looking at risk management practices in direct investment funds, and we'll go from now until 11, and we'll take a 15-minute break, and then we'll return for about 30 minutes to finish up our first session. And then we'll turn for a shorter 45-minute period to focus on fund-to-funds. We think they have the same sorts of issues plus more, and so we thought we should do a little breakout on that to hear about those issues as well. Then we'll take an hour break for lunch, and then we'll turn to a session where we compare the experiences we've heard about, and we'll try to see whether there's similarities, differences, takeaways that we can get from that, best practices, what view of the future, that sort of thing.
When you're speaking, to use your microphone, you'll press the button. When your microphone is live, the red light will come on. When you're finished speaking, just press the button again.
Thanks. Okay, so let's go around the table. Let's start here and maybe briefly introduce yourselves and your institution.
Sure, I'm Tom Lloyd. I'm the General Counsel with Campbell & Company.
Heidi Kaiser, Deputy General Counsel, Chief Compliance Officer at Campbell.
Philippe Pradell, I am a fellow at Campbell.
Stephen Felsenthal, General Counsel and Chief Compliance Officer at Milburn Ridgefield Corporation and its affiliates.
Hi, Warren Pennington. I'm a principal at Vanguard Group.
Hi, I'm Manish Mittal. I'm General Counsel at Halcyon Asset Management. We're a alternative asset manager managing about $13 billion in hedge fund and CLO assets.
Hi, I'm Katie Plavin. I head our investor relations effort at MKP Capital Management. MKP is a diversified alternative firm founded in 1995. We manage over $8 billion in AUM across 2 core strategies, credit and global macro.
I'm Dov Lando. I'm the General Counsel and Chief Compliance Officer at MKP Capital.
I'm Todd Spillane, Chief Compliance Officer for Invesco Advisors and for the Invesco Funds.
I'm Nicole Tortorello. I'm Head of Investment Structuring at UBS Alternative and Quantitative Investments, and we're a fund of hedge funds.
I'm Jay Nicholas. I'm Global Head of Operational Due Diligence at UBS Alternative and Quantitative Investments. We're a $29 billion fund-to-fund.
I'm Greg Robbins. I'm the Chief Operating Officer for Mezro Advanced Strategies. We're a $13.5 billion fund of funds with offices in Chicago, London, and Hong Kong.
I'm Emma Rodriguez Ayala. I'm the General Counsel at Mezro Advanced Strategies.
Thank you all. All right, so I guess we've worked out our questions here. So to start our conversation, let's go around and ask each one speaker from each group, I guess, or they can join each other for you. But from each institution, let's talk and get a picture of an overview of your business structure and maybe the governance structure for that business, composition of the governing body, and then the types of risks that business structure creates, and how those various types of risks are addressed. So basically, overview of the kind of business, governance, just high level, how do you do it, what do you think about, and then the types of risks that business process kind of generates that you look at, and then how do you address those risks. Okay, and we take our time, but let's go through each institution then. Turn it over to you, Tom.
Sure, thanks. Campbell & Company is a commodity pool operator and a commodity trading advisor, obviously registered with the CFTC, NFA member. We also have a wholly owned subsidiary that is an SEC-registered investment advisor, and a subsidiary that is a FINRA and SEC-registered limited purpose broker-dealer. So we've generally categorized the type of risks that we look at every day as sort of one category being regulatory sort of compliance risks, operational, counterparty, investment risks, human capital, and then sort of to sum it all up, strategic or reputational risk. From a governance standpoint, we're a closely held corporation, so we have a board of directors consisting of owners and officers of the company, and we have an executive committee that consists of 10 people, including the chairman of the board, CEO, president, and heads of each of the sort of business groups. I'm on it, the head of trading, two heads of business development, different divisions, and research, CFO, and CTO, Chief Technology Officer.
Great. Okay. Thank you.
Thank you.
Go around.
Okay. Milburn Ridgefield Corporation has not necessarily by that name, but we've been around since 1971. And which makes us one of the oldest, as far as I can tell, one of the oldest CTAs, CPOs around. We are also closely held, so we are owned and operated by the same people. There are 7 shareholders who form our executive committee, and then on a day-to-day basis, we're also managed by a management committee, which includes the various senior level people, including the executive committee members and people and the other people who are head of core areas of our business. And the reason we have that structure is because we want to make sure the people who are actually implementing things on a day-to-day basis have an understanding, one, of the entire firm and how it works and what the interplay is between the various groups, and to facilitate communication. You'd be surprised how much you miss if you don't actually meet in person and force everybody to talk every once in a while. You'd be surprised how much you miss. And the reason I'm making that point is that leads very well into the risk discussion, because if you have adequate communication and you understand what every line of business you have is doing, then you can properly identify risks. And aside from the general rule of follow the money, which is everybody's colloquial way of saying, that's how you find your real risks, because the real thing, the real temptation is to steal money, but there are lots of other kinds of risks. So, I use that as a platform in which I can identify. I listen carefully. In which I can identify risks and ask people questions and try to think about. And then I sit down with the business people and actually try to identify. Aside from identifying the risks, okay, what do you think is a good way to discuss, to address these risks, to mitigate them, and to test them? And I involve everybody in the firm in that kind of identification process and the testing process itself. So that's a general overview of that area. But we're also a registered investment advisor, and with the SEC, so we also have those issues that are unique to SEC registered firms, and a lot of them, I find more and more that the types of risks that you're concerned about, even from a regulatory perspective, even from a legislation, even from a statutory perspective, are very much the same a lot of the time. Or if they're not statutory in one area, there's something that you should be considering anyway. So in terms of dual registrants, I think there's tends to be more and more convergence and overlap. We are also have an affiliate that's registered with the FCA in the UK, and again, I find that there's very little that between the CFTC and the SEC, there's very little additional. There is some that I have to do for FCA kind of risks or UK or EU. There are some, but those types of risks, other than the statutorily prescribed things, which tend to be different, but a lot of the same concerns are being talked about over there as well. So that's my overview.
Great, thank you.
I think I'll go through a couple of minutes just to give you a perspective on Vanguard is one of the largest mutual fund firms with over $2.6 trillion of assets under management. The perspective we bring reflects the nature of a firm as well as of our shareholders. We are shareholder owned. The structure of our firm is that the funds own Vanguard. We've been a pioneer in index mutual funds. We currently offer open-end funds, ETFs, and fund-to-fund structures. And they're both active in index strategies. But almost all the assets that we manage are in funds registered under the 40 Act, the Investment Company Act of 1940. The governance structure we have in place reflects that shareholder perspective. We have over 18 million shareholders. They range from over 80 years old, a substantial number of them, and an equally substantial number are under the age of 21. So that gives us 4 generations of shareholders, from people who've lived through the Great Depression to the newest generation that has witnessed the global financial crisis and watched that. Our structure reflects the fact that they've hired us to invest according to the objectives that we've published in the funds. And they also expect us to manage the risks associated with the operation of the capital markets. So we provided a fund schematic that gives kind of the typical fund risks that are out there as one of the things to the staff of the CFTC. I would echo the comments of the earlier folks here, Steve and others. The regulatory requirements that are in place from the Investment Company Act cover quite a few risks that we manage. There are requirements around daily mark-to-market valuation, liquidity requirements, the requirement for daily redemptions, and a structure which has an independent board of directors over our funds. In addition to that, as an advisor, as the investment advisor, we're also subject to the Investment Advisors Act, which has other requirements around it that give us some risk management alternatives, things like reporting and record-keeping requirements, segregation of assets, and anti-fraud provisions. I would like to point out that Vanguard's mutual funds, as well as our collective trusts, are actually exempt from CFTC registration under Rule 4.5 exclusions. So that forms part of the discussion here. So we appreciate the fact that we can participate and your inclusive arrangement to the discussion. Thank you.
Hi, I'm Manish Mittal from Halcyon, and until Steve started speaking, I thought we'd been around for a long time, but we've been around since 1981. We manage, as I mentioned, hedge funds, CLO assets, and recently we've started sub-advising on 40 Act funds as well. When it comes to risk and risk management, I'd say that by far our greatest oversight comes from our investors. We've been voluntarily registered since 1997. I'm formerly from the SEC's Enforcement Division. My CCO was in AUSA in the Securities Fraud Unit in the U.S. Attorney's Office. And while we both have a government perspective, there is nothing that compares to the type of oversight that we get from our investors, some of whom are at this table. And they come in routinely and they do their job. And it's quite systemic, and I understand why they do it. They are fiduciaries to their own investors, but it's evolved certainly since 2008. One of the things we get asked now, and one of the main things that we look for in our agreements, is to look at the counterparty risk of our counterparties, of the broker dealers that we're transacting with. So we've instituted a monthly review where we have a consultant who used to be with one of the prime brokers. We have one of the lawyers who deals frequently with all of these folks, and then we have an insolvency lawyer who specializes in derivatives, former colleague of yours, Gary, Aziz, who looks at our agreements on a quarterly basis to make sure that we're getting the best terms and that we're getting the right triggers in case the counterparties themselves default. So risk management has taken on a significant aspect in our business over the past few years, which is fortunate for us. We've always touted our risk-adjusted returns, and now people are asking about that.
Interesting. Thank you.
Hi, I'll just speak to the structure of MKP Capital, and I'll turn to my colleague Dov to speak about some of the risks that we face on an ongoing basis. MKP Capital is structured as many hedge funds are, with a management company overseeing a number of onshore and offshore entities. Our management company is led by our CEO and 4 other principal owners, which collectively are our management advisory committee. We've separated the business really into 2 distinct groups, the investment side of the business, and then what we would typically call operational side of the business, which comprises marketing, investor relations, middle and back office, our technology group, legal, HR, finance, etc. Our investment side is comprised of our portfolio management team, our risk team, as well as our research and strategy group. There's a number of overlapping committees and groupings to make sure that everyone is aware of the firm collective risks. We've, as I mentioned, the management advisory committee, a formal brokerage committee, compliance committee, valuation committee, and we additionally have an independent board of directors that weighs in on our individual fund offerings.
Actually, you already touched on a lot of the governance and control functions. Just to expand on that, is obviously there's a myriad number of day-to-day risk oversight procedures. We really focus on it on a continuous basis. But I think Katie touched on the key more formal control functions, which, again, things like the compliance committee, a brokerage committee, our valuation committee. I do agree. I would second, and probably Katie would even be better able to speak to that. But what Manish had said about the pressure we're constantly getting from our investor base, very legitimately, the investor community wants to hear that we're focused on all these risks, and they don't want to hear when they come in that they raise a concern and then we say, oh, that's a good point. We should find a way to address it. So we always have to be thinking ahead and predicting what their concerns are going to be. And they're very, focused on this. They're thinking broadly as well. They're creative about it. I personally, in a previous point in my career, worked at a fund of funds, and I was on that side of the table. And I think fund of funds are interesting in the fact that they are themselves funds, and they have to deal with all the risks that come with running a fund. But then, obviously, they have to be overseeing the underlying funds that they invest in. I think they'll be better able to speak to it, but I think it's, different funds are very different in the terms of the types of risks that they're facing and the way that they should address those risks. And so, fund of funds come in, I believe, in my experience, with that kind of flexible approach. They have things that they want addressed, but they also are sympathetic to the fact that different organizations will be organized differently. And then, in my personal experience transitioning over to a trading fund, any organization will focus on the risks that they face on a day-to-day basis. If you, for example, use soft hours, then that's a particular risk you have to address. If you don't use soft hours, then that's outside of scope. Just again, as an example. But I do feel that it's important to continuously challenge yourself on those risks, continuously. I mean, one thing I'd say is, in my mind, there's a 3-level approach to it. You have certain things that are in place all the time that you've put in place that are supposed to monitor and mitigate risk. As part of that, there should be on some frequency, let's say a quarterly basis, a summation of that, or like, for example, a brokerage committee meeting if you're talking about best execution. And the brokerage committee will meet and overview what's happened over the course of the quarter, make certain decisions. But then on a third level, with a lesser frequency, let's say an annual basis, to take a step back at a big picture and say, is the system we have in place appropriate? Are these quarterly meetings focusing on the right things? Is there some new development because of a change in a regulatory environment, or change in our business, or change in an industry that we have to take into account and we have to adjust? Because you need to address those things in advance. You cannot be reactive to those kinds of pressures.
I just want to throw one thing on what you said, Tom. It's also a daily thing too, right? So, I just think about what's going on in Russia and Ukraine and everything else, and sort of a new risk that popped up for us we need to be aware of. So it's not only the quarterly and the annual, which obviously I agree with, but it's a daily process too. So Invesco is a very large public company. I think many of you know it. We manage north of about $775 billion at this point in time. Primarily in the United States, a mutual fund company, although we do have a fairly large institutional business. We also run private equity. We have got a private equity distressed debt firm, private equity fund-to-funds firm, a bank loan firm. We do real estate, both securities and direct real estate, high net worth, pretty much everything you can think of in between. Also with a large number of affiliates overseas that do something similar in their jurisdictions, including the UK, including Frankfurt for Germany, for continental Europe, Canada, Japan, Hong Kong, Australia, Taipei, Taiwan. You get the general idea. The reason I bring those up is those are all service providers for me in terms of the funds. So it certainly brings those elements of risk, and we need to be paying attention to what's happening not only in the United States, but it's also happening on a global basis. At Invesco, we have a corporate structure that the firm is managed essentially by about 14 SMDs, senior managing directors, over each one of the different business lines, then the shared services, which includes legal, compliance, operations, IT, accounting, those kinds of things. The SMDs comprise what we call a CRMC, which is a Corporate Risk Management Committee. They meet on a quarterly basis. They get presentations by each one of the different business units on an annual basis. So it's sort of a cascading effect. So the risks get sort of bottom up, but they also get pushed from the top down. Each one of the business units is responsible for having its own risk management committee. So there's about 14 of those that happen periodically throughout the year. I'm fortunate enough to sit on a couple of those. And again, we do reports from each one of the different business lines, identifying, previously before the meetings, obviously, identifying any new risks or any changes we see to the heat map. In addition to all of that, we have a lot of the things that a number of people have already mentioned, including the funds board. We have a compliance committee. There's a number of other committees too that hear reports from the advisor on what's happening. We actually do probably more meetings than most fund complexes. We do 8 regularly scheduled meetings. I do a presentation at every single meeting, including the opportunity to have an executive session with the trustees at each meeting. Risks. Again, investment risk is key. We have a separate 100-person dedicated group that is only looking at investment risks and doing very deep fundamental research on each one of the portfolios. They will meet with the group CIOs on a semi-annual basis to review each one of the portfolios with the portfolio managers there and asking sometimes very hard questions. Why did you do this? Why did you do that? In addition to the compliance group, which is doing its daily work and quarterly work and annual work, in addition to the internal audit group, which is also looking at all these kinds of things. So I sort of would describe it as a compilation of all the different components. There is no one set risk program, shall we say, but it's a compilation of all those things that give, I think, our CEO and I would say the chairman of our board a comfort level that we can deliver on the things that we promised to our shareholders. And the worst risk of all, I think many of us all know, is the headline risk. It's really not terribly important that the headlines are true. They're there. It is a reality. Perception is reality.
A&Q sits within the broader UBS. We sit within Global Asset Management. Our management company is wholly owned by UBS AG, which is itself a public company. A&Q is registered both with the SEC and the CFTC. And we also have an affiliate that's registered with the FCA. We have offices, our main office is in Stamford, Connecticut, and then we have offices in New York, London, Zurich, Hong Kong, and Tokyo. From a governance perspective, we have a number of committees that manage our firm. One of them includes a management review committee that meets on a monthly basis. All the participants are the heads of the various different groups, and we cover the transactions that have occurred for the month and discuss various other issues. Also, being within a bank, we're structured probably a little bit differently. We do have our legal and compliance group that is in corporate center and is not in our business line, and they report up through different channels up the bank. And that is the same also with our risk control group. They also report outside of our business lines. Separately, I think, as being part of a bank, we're also subject to an internal audit, and so we're subject to those risk controls as well. And then Jay can talk about some of the things we look at from a fund of funds perspective when we're looking at risk on the hedge fund side.
Sure. I'm sure some of the things I will say will be similar to what Mesro says as well. But, some key things we have to take a look at is, one, the investment risk, what return we're looking for, and what's the risk we're willing to accept with that. We break our teams down into a couple different categories. One is an investment team who's broken down by different strategies. So while we're focused, specifically on commodity operators, we invest across a wide variety of strategies: equity, long, short, CMBS, macro, currency. We also have the operational due diligence team, which I head up globally. Our job is to understand the risks of these hedge funds from a business risk standpoint, understand what controls they have in place, what we can do to mitigate certain areas to get more comfortable with things. We invest in a wide variety of hedge funds. They could be super large to some of the size people that we have here, to they could be very small. They could be 3 to 4 to 5 people shops, where we need to figure out how we can best create a control environment that we can get comfortable with the money that we invest, so that we know when we ultimately redeem, that money will be there. I think some people have pointed out as well, like Todd and Invesco, it's not just a monthly process, it's a daily process that we need to understand. We look at funds also with a risk group who will take a look at the returns that have been produced by the various funds, where we question and run our own analytics to make sure that things make sense. So it's a combination of both qualitative and quantitative, both top down and bottom up when we look at funds. Some key things we look at would include liquidity. So because we have our own products that we manage, we have certain liquidity profile for our investors. So we need to make sure that our funds can meet the liquidity of our investors. So we have to look at what we invest into that we can do that. And that could be a combination of funds that provide monthly, quarterly, or annual time horizons. The other thing we'll spend a lot of time on is understanding how those funds are set up from a governance perspective. Nicole actually heads up a lot of that group, which we like to call client advocacy, but it's making sure that we have an independent board of directors who is there in case we feel that the manager isn't representing the fund and investors in the best interest. We have a conduit that we can go to. And I would say we, and also Mesro, have been pretty influential in trying to push that standard forward. Just running through real quickly, and I won't go into too many details, key things that we'll look at, not only from the investment standpoint, but from the back office is how is the firm structured? Where is it structured? How is the fund structured? How many staff do they have? Do they seem competent? Valuations, do they make sense the way they do it? Is there some way to independently verify it? Is it done consistently? We'll take a look at the trade processes, the reconciliation flows, cash controls, who can set up an account, who can move money, what kind of service providers are involved in that. We'll talk to them about counterparties and financing. Leverage gets a lot of highlights in terms of what took place, from 2008. So understanding how do funds manage their financing to match the asset duration of the investments that they're making. We spent a lot of time on that, as well as how do they calculate and do that. We want to understand how do they handle compliance. Goes without saying, compliance has been an enormous growth, not just in the US, but also worldwide. So how do funds manage that? In some cases, it's being done with in-house teams that have grown. In some cases, the consulting environment has grown dramatically with people who are ex-SEC, CFTC members who help them out. And business disaster IT recovery, what controls are in place there, right? The key thing is really making sure in that case that they have the ability to operate. We've had hurricanes hit the East Coast. We've had earthquakes. How do funds manage that? What I can tell you is, in general, hedge funds manage that very well. The other thing we look at is the service providers, verifying who they use, both through emails and phone calls. And it's amazing that the service providers, as they get to know you better, are very upfront about, which clients, obviously they have clients, they want to protect them, but they'll tell you who's easier to work with, who's not easier to work with, right? And our approach has always been pushing the boundaries higher. So what would have been acceptable back in 2000 may not be an appropriate standard now. And so while MKP and Halcyon say that, investors are pushing them, I would say we're probably in that category of always raising the bar to make things stronger and tighter. When we talk about reputational risk, no one likes a hedge fund that blows up. You certainly don't want to be in it, but the reality is it's bad for the entire industry, right? And so that's how we manage our business.
Yeah, thanks, James. I think just to put a little more meat on the bone of what James has said. Well, first I'll start with Mesro, since you asked about our specific business structure. So we sit within a holding company that is private and employee owned. The principals in our business own more than 5% of the shares of the holding company. And so from an incentive alignment perspective, that's something that's extremely important to us. And in fact, at the level of our executive committees and our investment committees, which are two of the main governing bodies of our firm, we have an agreement that we're required to invest 25% of our after-tax net income in either shares of our holding company or in our funds. So it's a big deal to us to have incentive alignment with our investors, and that I personally and people in those roles have a lot to lose if our business doesn't go well, just as our investors do. Similarly, as MKP and Halcyon know, we demand that the managers we invest with have a significant portion of their net worth tied up in their funds and their businesses for the exact same reason. We think it's a great way of creating incentive alignment. Back to the formal governance structure. So we have an executive committee that is the overall governing body of our group within Mesro Financial. We also have an investment committee that's responsible for the investment decisions that are made at the firm. And we have an operating committee on which my colleague Emma sits, as well as I, that is in charge of helping to identify and manage the operational risks and operations of the firm. Like Steve at Milburn, we've taken both a top-down and bottom-up view towards identifying and managing those operational risks. And I think as as you think about this, those risks are really less tied to our structure than they are to the types of businesses we do. So, we've identified in the spreadsheet that we put together for the firm, or the PowerPoint we put together for this presentation today, some of the risks that we generally identify in our structure and the investments we make. I think they've been already identified by others at the table: investment risk, counterparty risk, liquidity risk, operational risk, and compliance risk. And we actually have a formal dashboard, a risk reporting dashboard that we use with our board of directors, where we have those risks enumerated, identified, and then tracked. And when the holding company's board of directors meets, they're looking at that risk dashboard and checking us and assessing where we're at on those identified risks. So we do have another layer of governance with regard to the specific, what we've identified as the major risks of our business. A separate point of oversight for us is our funds have an independent board of directors who we report to at least quarterly, and once a year we have in-person meetings with them. And to the extent there were significant incidents at our funds, we would have to report to that board of directors and get them comfortable with what we were doing and how we were addressing those risks. Going back to something James said and bringing this way up a macro level, we are not only managing investors' capital or operating funds ourselves, but we're overseeing the investment of capital at the funds we invest with. And just to hit on something he said, and Dov had mentioned this as well, I can't emphasize enough how each individual investment fund has its own unique risk profile. And I think one of the challenges for any regulator, and it's certainly a challenge for us as an investor, is trying to think of the industry in any way as kind of a monolithic or uniform beast that has one set of common risk factors. So just to give you a little bit of an example, at any time we're invested across 60 to 80 different hedge fund managers in maybe 80 to 120 different products that they offer. Those fall into the category. We generally bucket the strategies we invest with as hedged equity, credit, relative value, event, macro and commodity, short dedicated managers, and then just generally an opportunistic bucket. And within each of those, we have numerous sub-strategies, and we are expecting each manager within those strategy buckets and within those separate sub-strategy buckets to implement their investment program and to manage their risks in their own unique way that's appropriate for the expectations they have set for us. So like James and UBS, we create essentially tracking profiles, tracking indexes based on, say, what we expect the manager to be investing in from a sector exposure perspective, from a country exposure perspective, from a market cap perspective, and both their long and short and gross exposures. We have that tracking index running next to their performance at all times. And if at any time their performance deviates from that basic tracking index, we are on the phone with that manager trying to understand why that happens. We also roll that up to our portfolio level, so we're tracking those exposures across our entire portfolio, and we're doing a risk look-through. So as Halcyon and MKP are monitoring their counterparties, I'm sure UBS does the same thing. We're surveying our counterparties across all of the underlying funds we invest with and rolling up our global exposure to prime broker counterparties to understand where those are at. So I guess the overarching perspective I want to leave you with is there isn't a one-size-fits-all approach. The reason you need sophisticated people like James and Nicole and Emma at the top of this being a pain in the rear for our friends at the direct trading funds is because we view each of these very individually, and we're constantly evaluating and progressing how we think about risk, and as they said, and as James suggested, demanding more and more from our underlying managers so that we're all comfortable where we sit in the industry.
And what I would add also is that we have our own investors that perform the same due diligence on risks on us. So even for our portfolios, because we do so many custom portfolios for particularly large institutional investors, those portfolios sometimes have risk parameters that differ among them. So for us, it's monitoring the risk of the underlying portfolio, but also making sure that we comply with the risk expectations of our own investors, which often vary.
Wow. Okay, very helpful. I've got questions from questions from what do we do at the bottom, the technique to manage risk, but the discussion that sort of started evolving over here and came around, which was fascinating, was and I think it was in Dove's defense, it was nobody said ignore daily. It was yes, I wanted to jump in for your defense because I know you didn't skip that. But it was very interesting because, you think about, and you're hearing things about, the committees with the heads of the lines of the business, and you start thinking like, but could that get sort of ingrown, right? Because but then all of a sudden, then you're talking about, but then somebody was talking about the annual meetings where, and following trends, trying to get ahead proactively on things, and then the annual meeting to see how well is it working and are we picking up all risks. But I guess, so on the one hand, I want to get more detail about what people are doing on the daily stuff to manage these risks, but also maybe this sort of this governance or reporting up thing where the equity-like folks are, how do you make sure they understand what's going on and how is it being communicated, not just reactive, like what happened here and what kind of on-the-ground decisions get made, but also then as it filters up, seeing what's happening and making it understandable for people who are sort of like not the guys in the trenches. And if you have thoughts on that and how does it work in the fund space. But I heard that discussion. It was kind of fascinating. And you can see if you kept it just in the trenches, there'd be like potentially conflicts. And then there's also this education thing that's got to go on, and then it's got to be communicated up, and it's got to align itself with where people want this business to be going. So can we get thoughts about that sort of flow of information up and that decision making at the top, and then we can go back down later to talk about what are you doing really to, the more mechanical stuff to manage risk, those kind of risks that you all identified?
Sure, we want to start?
Sure thing.
With us again?
Yeah.
Sure. We have, I know several people talked about investment risk. That is a daily risk, and we're a model-based. We have a model-based portfolio, but we also have an investment committee that meets every day at 8:30 in the morning, and that consists of our CEO, our president, our head of trading, our head of research, and several input every day from several of the research groups. So you've got that on a daily basis. You also have our traders daily are, monitoring news, monitoring, they know who our executing brokers are and our prime brokers. And, they will have the ability, if news comes up about, or even rumors come up about a specific fund that's maybe an executing broker, you'd want to just pull them out, until something like that settles down. So, that's a good thing because it's like somebody else said, when you get that call, what's your exposure to Lehman? You want to be able to say none, right? That's the, that's sort of the goal. And our executive committee meets once a week, and literally, there are as far as how information filters up, we have again, people on that committee who are who basically run the groups that do the different aspects of risk monitoring. Like my group oversee the legal compliance team, the investment ops team, and the trading operations. Things like having the traders report up through a different chain than trading operations, which does settlement. To try to keep control the potential of a rogue trader type of person. So it is important, that it is a daily process for us, and I think for a lot of the, obviously for the trading companies as well. Heidi?
Yeah, I would say sort of at the top level or the highest level, the executive committee is thinking about what are the risk tolerances for the different types of risk that we face. But then when it comes to actually identifying the risks and monitoring the risks, that's really the job of the people in the trenches. And then you have to have a system in place where those individuals are identifying the risks. How are we going to monitor them? What are the key risk indicators that we need to be looking at on a periodic basis, if that's daily, weekly, monthly, quarterly? And then what's the probability of those risks materializing? Is it really remote? Is it near certain that it's going to happen? And then what's the impact of that? You might have a risk that is probably going to happen, but the impact of that is very minimal to your business, minimal to investors. But you might have something that's remote, counterparty risk. It might be remote. It used to be remote, but the impact of that is extremely great. So that's something that you're going to be looking at on a daily basis. But really the highest level is looking at then accountability. Who's accountable for the risks, and then letting sort of the trenches deal with, sort of managing them, mitigating them where necessary, and then reporting up, okay, what are maybe the top 10 that we're dealing with, or what has changed over the past year? What's a risk that we're facing now that we hadn't been facing before? Because I think at the highest levels, you can't be dealing with the weeds, but you need to impress what are our tolerances and what do you need to be bringing to us on a periodic basis so that we can be making decisions.
And at the risk of jumping in outside of order, when we're going around here, just because you address or ask specifically how do the executives at the top of the governing committees get educated about what they need to be thinking about, for us that is an ongoing process. Start of the matter is they all kind of started at the bottom level and moved up, so they do have a general understanding of kind of what's happening at the bottom level. When we do reporting to them, it's done on an ongoing basis for any large issues that need to be addressed. And we make sure that they understand both the intricacies of what we're talking about and the repercussions of the risk, right? The consequences of if it's not addressed. But also we systematically on a quarterly basis have a compliance meeting with the executive committee that we go through consistent risks that come up. And because of the risk dashboard that they all have to review as well and be aware of, we are comfortable that they understand kind of the big picture risk. When you're talking about the little picture risk, that's Greg's job, so he can address that. But as head of the operating committee, he needs to understand kind of all the technicalities of our business to be able to address risks.
Yeah, and I think I just can't emphasize enough that, and I think it was Todd who said this before, the daily, it's funny, we all come into our office in the morning with a daily list of tasks we want to handle, and then, we get picked apart by the issues of the day. And, we're, even though we're investing globally, we're a 127-person firm. So it's not like there are layers of decision makers between what's happening on the ground and the actual decisions that need to get made to address this risk. So I'd like to emphasize that it is a daily ongoing process of managing risk, and you're not only kind of reporting to other people internally, but as I think others around the table have mentioned, the outside pressure from our investors who are investing very large sums of money with us and have their own reputational risk concerns. Like UBS, ours is largely an institutional business, and the consequences to those of investors of being invested with us when something bad happens is extreme as well. And we take that very seriously, and they do. So to the extent there is a prime broker in the news with some kind of pressure, I guarantee you it's not just me walking over to the side of our research floor asking how we're monitoring that risk and staying on top of it. Our client team has beat me over there to say, I can't have this in the news with this exposure to this prime with our investors being upset about this. So we are constantly reporting to those people in a way that we take very seriously, and I assure you they do as well. So.
Sorry, don't lose your thought. I just wanted to ask a quick question. So, Heidi, going back to your point about essentially materiality, talking about the likelihood of occurrence and magnitude of if it occurs. So how do you, get into alignment, or if you're making that determination, materiality determination, well, I guess how you communicate it and how is it decided? So I mean, if the folks on the ground are implementing, or are they making the determination about whether it goes up, or is that being communicated down? You get a feel for what is contemplated to hit that band.
It depends on what type of category you're dealing with and who's addressing the risk. There are a lot of different risk assessments that might be made. On the compliance side, we do a risk assessment, and it's really myself and my team that are assessing, okay, what is the potential impact, and what's the probability of this actually happening. And we do a chart, and then the ones that are either very significant in terms of impact or are very likely to happen are the ones that we'll raise to, say, Tom or executive committee. And then with that, we're also looking at what are the internal controls or ways that we're mitigating these items. And it may be that there's an item that there's a high impact or high probability of happening, but we're very comfortable with the controls that we have in place, the procedures that we have in place, and maybe the training that we've done with our employees, or the way that it's being monitored, that we feel comfortable that it's, either EC is already aware of it, is getting information on it, and it's nothing we need to take action on. If it's something that maybe is new, then we need to talk to the players and figure out, okay, well, how are we going to manage this? How are we going to monitor this?
And just to add to that slightly, one of the things that more and more, we have obviously fund of funds, institutions, our own sponsored funds that are sold through selling partners, but more and more of the due diligence teams, obviously are digging deeper and deeper and deeper on this. And a lot of funds like us are doing what used to be called a SAS 70. It's now called a statement of control. We had an investor who required that years ago, so we've been doing that. And it's where your entire control process is set out, sort of from beginning to from a dollar comes into a fund or a dollar comes into a managed account. Here's where it goes. And then we have our corporate outside auditors who test that, and so it's helpful to be able to deliver that to, and it used to be a real market, plus with institutional investors. I think it's kind of becoming baseline, and maybe you guys can talk about that. I know it's baseline for, for outside administrators, and obviously that's some of the, if we're going to have something administered externally, obviously that type of due diligence with them, it's, it is pretty baseline now.
Yeah, our client base is largely institutional, pension funds, institutional investors, and the fewer times that you can say no to something, the better.
Sorry, if I can jump in on the SAS 70 or the SSAE 16 that you were talking about. It hasn't actually become that commonplace. We see some of the larger firms deciding to do it and pay for it. What we have seen is almost the requirement of these independent administrators to perform that task. So before 2008, it was not uncommon to have funds do their own accounting, to have an administrator who basically just took the NAV that they produced and just sent it out to investors. That has dramatically changed, so that you have essentially parallel books and records being done both by the hedge funds and by the administrator who reconcile between the two. So I just wanted to make sure we're clear on that the SAS 70 or what's now the SSAE 16, definitely not commonplace.
Okay.
But I think that's one of the interesting things about the industry, right? The people here, we do one, we'll do anything, right? If I ask for a resource, if I need to hire a person, I'll get a person. And you have funds here that specialize in distressed investing, so our PMs are very focused on this. We have independent boards. We have, I've got a 10-person team. The problem is that you're looking at an industry that's very diverse, and so these guys can speak much better to the people who aren't like us. I'd say we run fairly similarly to a broker dealer, in a sense, in the way we do risk, and that's voluntary, right? It's voluntary, but it's coerced because the investors are going to demand it. And I'm not going to get pension fund investors coming to me. Otherwise, they'll go to the smaller guys seeking alpha, And they might be willing to go to a 5-person team who's not doing a SAS 70, who doesn't have my 10-person compliance staff, my back office, my operations, and it's very hard to look at the fund industry as a homogenous group, because you've got the folks like us who have the resources, have the experience, the PMs, especially when you look at shops that specialize in distress. Every single day they're looking at counterparty risk because that's their training. They would be, it's in their DNA. They wouldn't do anything differently.
And it's not just because I don't want to give the impression that, that these guys show up at our office and say, we'd like you to jump up and down and stay in the air for 30 seconds at a time, that we're going to go do that, although we would.
I will.
But no, in seriousness, it's not that every question they ask, if they come in and ask for a SAS 70 or a SSAE, whatever it is, they change names, I lose track. But, a lot of these, not everything is driven by the due diligence, the consultants and the due diligence people who come to your door. Everything's driven by, wanting to be a clean shop without having any reputational issues and wanting to do things the right way. And, yes, when they come in and ask us questions and we say, oh, yeah, we do that. Yeah, that's a perk. That's great. And that's the only way you're going to get any kind of institutional investment. But you're not always relying on such sophisticated due diligence providers. There are people in between who aren't capable of doing that kind of due diligence. And I don't want to give the impression that that's the only thing driving this kind of risk management exercise or anything like that. There are lots of drivers. The most important one is wanting to stay in business and not wanting to end up in jail. And a lot of those things are, that on a basic level, there are lots of drivers, not just these questions we got. I actually brought with me a due diligence questionnaire, not to share, but these things are lengthy, and they get you thinking a lot, and they're getting lengthier and more specific. Like I was looking at it, trying to think, okay, what are the kinds of questions we were asked? I first got to Milburn in 2004, and back then the due diligence questionnaires were a lot shorter. And they were more willing to accept due diligence questionnaires that were there's this AMA form due diligence questionnaire. And now everybody seems to have their own questionnaire, and they want you to answer their specific questions. And they're getting more and more specific, which actually, as much of a pain as they are to fill out and to have to review every one of them, but they are helpful in terms of, I divide risks into trying to identify risks into subjective and objective sources. And, one of the things for objective sources are these questionnaires, our enforcement actions, our new rule releases, what's mentioned, reading actually these 100 whatever page rule releases and looking for the nuances and the things that the concerns raised, not just the rule itself. We all want to abide by the rule. You can read the rule. It's, whatever it says, and you do it. But what are the concerns and the reasons that went into a particular rule and things like that? And then you look at, aside from the enforcement actions, there are lots of these periodicals out there. There are law firm alerts. There are all these things that are all helping us identify the things that we should be concerned about. And then on the flip side, there's the subjective things where you meet with your people, whether and before, I focused more on the top down, but on the bottom up kind of thing. There's nobody in my firm that I'm not meeting with. Everybody from the person who's sitting at the front desk, the receptionist, and trying to figure out what the risks are that are associated with her responsibilities. Is the door locked? Is when you leave? If you go to the bathroom, can somebody just walk in? If you, whatever it is, not everything is a technical risk, and those are very daily risks too. Where are the files kept? Are they? Is it locked? Is it secure? Can anybody get in there? How? and mitigating those, such as putting cameras in place or having the door locked and things like that. And then there are things that are so important in terms of daily kind of risks that, and again, we're mostly a quantitative shop, so so a lot is relying on algorithms and models and things like that. And so one of the challenges is to hard code as many of the risks away in order to mitigate them. Now you can't get rid of everything, but you say, such as speculative position limits and other types, or even position accountability reporting, which is different than speculative position limits, and other types of trading kind of just daily risks that could come up at any point. The more you can create systems where something can't occur because the system won't let it go through. Now, clearly everything doesn't work that way, and you can't just rely on that. But for daily risks, I try to automate as much of the prevention as possible, but not rely on it. I guess sort of, trust but verify. And so I think that's an interesting aspect that, and these days there's so many ways to automate things and so many things and such reliance on these things, which facilitates our ability to then test and focus on other things that can't be automated. So it's a changed world in that respect. But I do find also, people have been in this industry for a while, especially, your operations folks, your accounting folks, your traders, and people like that. I'll wake up in the middle of the night thinking of a risk, 3 o'clock in the morning. I mentioned earlier when we were talking a little bit, it reminds me of the Seinfeld where Jerry wakes up in the middle of the night, writes down a joke on a little piece of paper, and then goes back to sleep, and he can't find the paper in the morning. So I usually find the paper, but I think of these things, and then you go into work, and typically you go to the trader or a trader and say, oh, well, what if this happens? And they have an answer. They thought about this already. It's a very, surrounding yourselves with quality people who are not necessarily compliance or legal people, who really understand the business and can relate to it, and incorporating them as an integral component of your program in identifying and dealing with risks is integral. And I don't know how you could operate without that. You could have 20 compliance people walking around and and 20 of them, and all 20 of them would never really understand what a trader did until they sat in the trading room for a month and actually, traded. And they're not doing that. Nobody wants me trading. So I think, that's an interesting way to think. That's how I think about it. In that sense.
Yeah, I think one of the you hit the nail on the head, and that I have the luxury of being glib about these things and saying, you ask me for something, I'll do it, because it's all, you're asking the question a different way. It's internally driven, right? My when we did the SAS 70, it's because my CFO thought, hey, I think the partners would appreciate this. When I was in the government, I remember in 2004 thinking about hedge funds as these lightly regulated shadow funds, and they're not. For the most part, they're franchises, and people are treating them that way, and people are running them as responsible businesses. You have problems just like you have in every industry. There's going to be a percentage of policemen, percentage of doctors, percentage of lawyers who are going to be corrupt. But for the most part, the industry is fairly institutionalized, run by people who, one of the differences between hedge funds and other industries is, people who are very aligned with the interests of the fund. It's not like you hold a few shares of the stock and are getting a salary and a bonus. These are people who are completely invested in how the fund is doing and usually thinking long term, not 1-2 year returns. So risk management is just core to the DNA of what a firm does.
And a lot of the whole idea of SAS 70, while I was happy to hear that it's not, has not become a requirement, I would have said the same thing. We have a fund-to-fund strategy, as well as we're a direct manager. And so we see things from both perspectives. And a lot of what we think about is, sometimes I'll meet with our fund-to-funds team and say, okay, what are the most important things to you when you're going to see a manager? And then I'll take that information and say, okay, well, let me think. Do we have these things in place? How do we deal with that? How do we deal with the things that are important to you? And then when a scandal comes up, at wherever it was, I go look at our file on that manager, because our fund of funds has probably looked at that manager. So I go and look at that file on a manager and see what their conclusion was, and why they reached those conclusions, what questions they asked that tipped them off that this, fortunately so far, was not somebody we wanted to go into, not somebody we wanted to invest with. It all started with, the scandal of he who shall not be named. So that was the first thing I did. And I found that to be a good process to think like a fund of funds person in terms of looking at what you're doing. And so I thought about the SAS 70, for example. We have some 34 Act filings, 34 Act filing pools. And so with that, you're required to make Sarbanes-Oxley representations as to your internal controls. Well, who wants to do that if you haven't actually tested your internal controls? That'd be a pretty stupid thing to do. So what did we do? We brought in an outside consultant to come in and examine our internal controls independently. So and I found many people have viewed that as a very good substitute for a type of SAS 70 for a fund organization, especially if you have an independent administrator that administrator, as was noted, probably has a SAS 70 also, or SSAE, whatever.
Garrett, when I think about, I'm sorry, go ahead. When I think about risk, particularly thinking about what you were saying, Steve, one of the things that when I first got there, I thought about what are the tools that, should I say, my people have to be able to use to identify potential issues, and making sure that we certainly have the right technology in place so that they're not looking for the needle in the haystack. Right? But one of the things I've talked a lot about at our firm is that I can hire a whole room full of people, an entire room full. Quite frankly, it doesn't dial my risk profile down one bit. I have to have the right tools in place, the right technology tools, and we spent a lot of money on technology. But then there's the second component. This goes to your point about escalation, right? So one of the things that is critical to the success for our compliance program is the fact that we really look to hire very experienced people into the compliance department. It would be unusual, more unusual than not, for us to hire someone 22, 23 years old right out of college. I think about the person who runs my fixed income monitoring desk right now. Spent 15 years as a money market trader, and then co-opted over to come over to the compliance side. And I have a whole slew of people like that who came to us from the business so that they understand the risks that are inherent into the business. Because, quite frankly, I can teach you the rules. I can teach you the communication skills that you need to work with our internal clients. I can't teach you 15 years of money market trading. I can't. Okay, so that's some of the things that when I'm looking for people in order to dial down my risk profile, that's important. But the corollary to all that, in my mind, is making sure that you have created the right culture internally, both within the compliance and within the business, that it is safe to raise an issue. And they happen all the time. It's not unusual. And if you don't have that, everything gets pushed down and your risk profile, in my mind, goes up dramatically. So I'm very visible in our firm, and people can come and talk to me. What I'm trying to get my people to do, and I'm very fortunate to have quite a few, is that each one of the individuals has their own network. I have my network of friends, shall we say, and so we create a spider's web. So we're creating a layer of compliance, and one of one of the consultants I know described it as distributed compliance. I actually thought it was a pretty neat term. So that I have touch points within, and I drew up a real fancy chart here, within each one of the different business areas within my firm. Each one of my staff members has a touch point, and it's more than one. So that at the end of the day, if there's an issue, if there's a risk that's now bubbling up and becoming more critical than not, we're going to get a phone call. And I will assert that it would be more unusual than not for someone to call the office of the chief compliance officer. It's not going to happen, folks. It's not. At the end of the day, this is still a people business. They're going to call people that they know. So part of my overall responsibilities, and I think this is the expectation from the board, is that they understand there is someone that they can talk to. And again, it's not just my job. This is all the way across the entire firm. That helps, in my mind, give us a lower risk profile at the end of the day, that we're not going to have a huge event, have a rogue trader go completely off the tracks. Because if somebody tries to do that, I'm going to get a call either from trading, one of my compliance officers who's actually monitoring what's going on in the trading. But if you even get that far, I'm going to get a call from operations and settlement saying, what's going on here? Why are we doing this? That's the mitigation that I'm looking for, so that we don't get those headline risks.
And I think along those lines, it depends on the size and the nature of your firm also. It is in a shop like yours, I can't imagine, it's not possible for you to know every person there, and for you to just walk around and chat with everybody there. You'd still be chatting. You wouldn't have been able to make it here today. But in certain smaller firms, and I'm not necessarily talking two-man shops, I'm talking places that have, say, 50 people, it is possible for you to for everybody to feel comfortable talking to you, and partially goes into education and how you approach everything. You never want to create a gotcha atmosphere, because then you never get meaningful feedback. You want people to understand that if they see something and they tell you about it, nobody's getting in trouble for it, unless, of course, it's evil. But nobody's getting in trouble for it. People make mistakes. Everybody makes mistakes. And the important thing is to, make us aware of, if you see something or somebody else sees something, make us aware of it. It's not going to get the person in trouble, but we're going to be able to handle it and fix it and move on. And once you create a track record of people understanding that you're not out to get them, and that you're all part of a team, and pointing out that if you're working in a shop that has one of these blow-ups, well, everybody then has trouble getting their next job. It's not, you could have nothing to do with the blow-up, but it's on your resume, nobody wants to hire you. So everybody, once they understand that and they see that, and you try to make it fun, you try to make sure people aren't thinking of evil compliance, stay away from them, and you put yourself on a different floor and everything like that, and as soon as you get there, everybody there's a phone call going out warning everybody you're coming. If a lot of it, and this is exactly what you said, on a different level in a smaller shop, it's just a matter of creating an atmosphere and getting getting everybody to feel like they have a role in compliance, risk management, and that they have a personal interest in making sure that they're working somewhere clean. And once you get over that hump, which I think it took me about a year, where people, when it first came in, people were thinking, oh yeah, he's compliance. Then we got to know each other. We went to lunch. We hung out. We created an atmosphere where they thought of me as a team member, not just another person. And I got a lot of open communication, and I learned a lot, and really understood how our business works. And now we're at the point where, if somebody has a problem, whether it's even if it's a personal problem, they're coming to talk to me about it. And it could have nothing to do with compliance, and which takes time, but it's a great atmosphere to have, and it's well worth developing, because you can really feel like you have a team in place, even if you can't hire a room full of people. You have a firm full of compliance officers and people who are testing risk management and are interested in mitigating your risks.
I think we're hearing one size doesn't fit all. I think one of your questions was initially, how do you decide what needs to get up to the boards, or in that governance structure, how do you decide what is material? So I feel like, within Vanguard, the Board of Trustees meet regularly, and each time they have a meeting, risk management is on the agenda. There's a topic discussion. Part of that is educational, so sometimes we'll be presenting topics to the Board of Trustees to make sure they understand the risks inherent in the business. And part of it is an ongoing reporting, sort of the state of risk management, so the highest level dashboards that would go. But the way those end up getting compiled is kind of the discussion we've had earlier. There's a breakdown of the various areas of risk. So the funds themselves have the investment risk within them. So you have to go way down into the weeds on a daily basis, as has been said over and over. So we will have, every single fund will have an investment risk view of that fund on a daily basis with thresholds and tolerances and heat maps and dashboards that end up getting into sort of a weekly or monthly report out to CIOs of the regions, and depending on the strategies, and that'll get up into the business heads and ultimately roll into an overall statement. Similarly, on the operational risk side, which is where you get into the advisor and the service providers, the distribution areas of our firms, we have a what we call a Global Operational Risk Council, heads of the businesses from the investment side, IT, a huge source of risk for all of our firms, fund administration, legal, compliance, audit. This is a forum where we get together globally and discuss the nature of our products, the nature of the operations, things happening in the markets, in our firms, and we have to form sort of the dashboard reporting to that group as well. You get into what are the policies that drive all that. So a small shop, which is great, you can actually go talk to each individual, get to know them personally. We don't have the luxury in a larger shop, so you tend to be more policy driven, right? So those policies get set based upon a variety of factors and the internal governance structure that we have in place. And finally, there's a general sort of a business view of risk, and that's the nature of the firm. Again, so we've got publicly traded firms here, privately held, a mutual owned, a bank affiliated or owned firm. So those overall business risks, which I think is a slightly different topic. So.
I just wanted to echo just briefly, what Steve said about sort of what we would call human capital. You have to have, and it's funny because in the CTA, CPO world, we have 140 employees and about 3.7 billion in assets, and we're not a small firm. We're not the biggest, but at this table, Milburn and Campbell are the small firms, but there are 3 to 5 people CTAs out there who are getting allocations because they're providing alpha. So obviously what they do is very different from what we do, which is very different than what Vanguard does. But when I also had a background at the SEC in enforcement, and back when it was NESD regulation and enforcement. So, and then was with a large global bank broker dealer before I joined Campbell in 2005. And one of the things, to go join what was then to make the jump from a big bank to a small hedge fund, in my view, small at the time, one of the concerns I had was sort of the integrity of the people. And they were very proud at the time. Again, we go back to 72 of having, knock on wood, a very clean regulatory record. And it's got to be, and that was sort of before we were just becoming registered with the SEC, so we had to put in a lot of different things into place. But it was so ingrained, and it has to be so ingrained in the culture of a company that you do things right, that you don't hide mistakes, that you report things up the channel, no matter where. The traders, the people in accounting, the people in again trading operations, which does the checkouts. If there's, just like obviously on a much smaller scale, but we would hear if something was irregular in a trade checkout. So really, human capital, hiring the right people and getting them, having them ingrained into the culture of your firm is very important. And when Heidi's team does the annual compliance training, we get every time you get people coming out of that with questions. Oh, I have an account here. Is that okay? Do I have to move it? Do I have to register it? Do I have to whatever? you do get positive feedback and you get feedback. So again, it's the roles of compliance and the roles of legal and audit are definitely viewed somewhat differently, in a larger organization. But you can still build relationships. But I think it all does start with people, and it's hard hiring the right people and then weeding out people who are not consistent with the culture of the firm. So
I know we're coming up on the break. I don't know if
We'll cut the break short. It'll be fine.
We'll cut down.
No, I was just a lot of it is echoing what's been said, and maybe to reiterate a point I had said earlier about the three approaches, three levels of approach to risk, and what I really think of them as a circle, because you have the daily procedures, you have the periodic, let's say it's monthly, quarterly, and then you have the occasional, let's say it's once a year. But they feed each other. So it's, for example, that annual review, which is what decides, well, what procedures should we have in place that is on a daily or, frankly, real-time, in a lot of cases, basis. So the point I was going to say is, especially if you think about it on the operational side, in terms of the daily, I would very much echo the significance of the individuals involved in the organization. In my experience in this industry, one of the things that I've always been impressed in, you have a very high caliber of people. They take a great deal of pride in what they do. They take pride in their function. They take pride in their firm. They understand the larger picture. They're not just, with a very narrow focus, like this number has to come in and I plug it in here. They understand where that fits in the organization, and therefore they understand when something's not being done right. And you have to have the right culture. Absolutely agree in terms of empowering people to speak up and to know where they should go and to feel that they're going to be encouraged and, frankly, appreciated for speaking up. So again, the way I think about it with this three legs to that stool, on the daily basis, it's about having strong procedures in place so that they're thought out in the first place, so that if something goes wrong, it's going to be caught by one of those procedures, and that the people who are involved in running it are going to know what to do about it and know that they have to do something about it. And then when you think up at a higher level, whether it's on the monthly, quarterly, or more on the annual basis, what I try to do is to try to make sure that different functions are subject to some kind of annual gut check. And just to give some examples that, some of these are specific to our firm, some of these are just generally industry practice. One is, it's already been mentioned, but the formerly known as SAS 70, the SSAE, that's a very good control review of operational controls, and you're really put through the ringer when you go through that, and it does force you to question yourself, and you're doing that voluntarily. That's something that the firms are doing. Yes, obviously to some extent it's marketing, but a lot of that's internally driven just to make sure that you're doing things the right way. Other controls on that less frequent basis, there's obviously the NFA self-exam. That's a great opportunity to review your procedures, not just check it off and compare to Blackline to last year, but to revisit everything. Has the business changed? Has the industry changed? Are we giving the right answers to these questions? In parallel to that, obviously under the SEC, which many of the industry are subject to, they also have an annual compliance review requirement. And that is also something that you have to tailor to your own organization. But I think it's a very healthy opportunity to take a broader view of all your risks and make sure that you're addressing them in a reasonable way. Other things that I think are common in the industry are just on an annual basis, reviewing your policies and procedures. Again, fresh look, think about what's changed. It's already been mentioned also, it's common in the firm to have annual employee education. And that in itself, even preparing for it, is a gut check. And then you actually perform it, and you're talking to every single employee at the firm. At our firm, it's at least once a year. We have a mandatory firm-wide employee education. Every single person from every single group is going to go through that. And they're really encouraged to speak up, to give feedback. And I do learn things at the end of it. People come to me and say, oh, here's a thought about something. And I'm glad to say it's not, I don't get surprised, but it does give me a pause. Maybe, oh, here's something we can refine. That's a good idea. Let's follow up on that. There are other, again, infrequent reviews. We review our offering documents. to make sure that they're still current. We obviously have the financial audits of the firm, which is another gut check on the valuation process, which is obviously a very critical process. And to, I think, the point that you had started the question with is those also lend themselves to feeding information to a senior level. So a lot of these things are reported. At our firm in particular, we have a compliance committee, which has representation from senior members of every aspect of the firm. So that's a good forum where we can report changes to our policies and procedures, where we can report the NFA annual exam, we can report the SEC annual exam, and it's a method of making sure that the people at the top are well informed about what's being done, and also since they're the people with the biggest picture, they can push it back down again and say, well, how are you addressing this concern? And it's a constant ongoing cycle.
I just want to. Sorry, Manish. I just want to make sure there's one group that I don't think we've. I mean, you're getting the picture. I think that there's this huge mosaic of people in charge of risk or that contribute to the risk process. I want to make sure we didn't omit third-party service providers, because one of the things that I think is really critical for you to understand is that you not only have the internal people that folks have been talking about who are constantly on top of this, you not only have gatekeeper operational and investment due diligence teams that are looking at this externally and also sharing best practices or pushing towards best practices that we see across all of these really smart people who are internally developing their own best practices. But, and Dove touched on the audit process. It's not just the audit process. The law firms that are involved in this practice area tend to be very sophisticated and very in-depth in terms of the regulatory compliance issues. We also have credit facilities. I think most people here either probably use credit through a PB or through a third-party lender. Those people are in our business because they need to be, and we're constantly reporting to them on risk metrics and measures. We do FX trading on behalf of some of our investors, and so you've got those counterparties who are, we're monitoring them, but they're equally monitoring us. And we've talked a lot about SAS 70s here, and I just want to hit on something James said. After 2008, it became industry norm for there to be third-party admin. Obviously, the SEC's custody rule has something to do with that as well. Those third-party admins are the biggest AAA-rated great credits in the world and have their own SAS 70 and compliance and audit departments. They don't move cash. Our funds don't move cash without instructing them to move cash, and they don't move cash without knowing where it's going. Right. And so I just want to point out from a risk control perspective and importantly, from a fraud control perspective, cash doesn't move within our firm. It stays external. And then the same process goes for valuation, right? Like even if we're doing shadow accounting or watching our own books and records and our managers are doing the same thing, valuations are being done ultimately by third-party service providers who aren't, by the way, valuing these positions in isolation. If 3 different credit managers share the same admin and try to put a different mark on the same position, all 3 of them try to put a different mark on the same position, that admin is going to have a conversation with those hedge fund managers. So I just want to make clear that you've got gatekeepers, you've got the people internally who are developing these processes, you got the gatekeepers who are demanding it and sharing information in terms of best practices across firms. And then you do have third parties who, frankly, are often the deepest pockets in this game and can get sued if things go wrong. And so they're extraordinarily interested in making sure that risks are tamped down and managed at all of our firms. So just want to make clear that that's part of the mosaic here.
I mean, to piggyback on what these guys were saying and what Dove was saying, we do all of the same processes that you're talking about. And, the people who lead it, I hired a guy from our audit team at PwC as our deputy CCO and a guy from the NFA exam staff to be our analyst who do the forensic testing. But that's, when you go across this table and look at what investors demand and third parties demand, there is so much that we are forced to do to run a good business, and it starts with the human capital point that you were making. And you can't legislate or regulate against that. really, because you can't regulate fraud, right? If somebody wants to do an annual exam that doesn't mean anything, or wants to do these things that don't mean anything, they will. We've all seen that. So it really is dependent on an industry that's somewhat mature. We're much more mature than we were in 2008, and that's really policing itself to ensure that it sustains.
And I would just add one thing to follow up on the third-party administration. Obviously, post Madoff, it is required, right, to post independent NAV calculation. So you have firms like our size who had always done internal NAV calculation within a fund accounting team that you knew and trusted and had the processes tested and all of that. But so a lot of folks, I think James mentioned this, are doing full shadow accounting on their third-party administrator because you want to make sure they're doing it right. Now, and they have, as Greg said, tremendous, incentives to do it right. But you have, your internal people doing it, comparing NAVs, comparing prices, and they're getting, they're all getting, feeds from the prime brokers to test it out. So, the controls, the additional controls of that third-party administration has brought to bigger funds has obviously, improved the risk of that level, which is bad pricing and obviously some problem with NAVs pricing.
That was great. It was greatly appreciated. So we've got about 15 more minutes till we go to the next section. And we wanted to, we thought we'd covered almost everything that we'd been wanting to cover in this session. We did want to ask you, how do you, this is sort of an on-the-ground kind of question, how do you address situations where there are things that are inconsistent with your risk management program, when you do find breaches or violations, and how do you typically deal with that? And the other one was, somebody talked about Sarbanes and talking about what outside administrators require. How do you test the efficacy of your policies and procedures, or whatever mechanisms you have in place, to your controls and so on? How do you test efficacy, and then what do you do when something goes awry?
I'll start on efficacy just because, as I mentioned, we just hired a guy from the NFA exam staff to help us with this. Our view is that your policies are only as good as they are implemented. So you can draft the best policies in the world, but if you don't know that they're actually being followed, what's the point? And it's a key concern when the SEC exam staff comes around to folks like us too. So we have actually a 4-person staff that spends a large amount of their time on forensic testing. And every single policy we have, and I actually have our risk matrix here that has the test for it. But every policy that we have, we test. So I don't care if it's, whether or not you have outside business interests, then we have a test for it that we'll randomly select a partner and Google search them, or, however you can come up with a test, we task the examiners or our analysts with that. And that's, I think, extremely important. It's not required per se, but the SEC will demand that of anyone that they come into. As to what do we do when we find problems, it's important to remember that we are lawyers with a client, and the client is the firm and the fund. So we will report up. And then if we need to, we'll hire outside counsel, we'll conduct independent reviews, because, again, the client could be the fund in that instance as opposed to the firm, so you want independence. But the situations vary, and I think that it wouldn't be smart for me to say, well, of course we would report or do anything, because we're lawyers and we have a client, so we have to do what is prudent and responsible.
I think it goes a little bit to order of magnitude, right? So every day you're seeing little nitty stuff that happens, and the question is, at what point does it become more systemic? Is there a pattern, et cetera, et cetera? And what I'm looking for is to be able to sort of nip it in the bud, hopefully, so that it doesn't happen 10, 20 times. And there, I want to make sure that we provide some level of education, but it's also letting the respective management teams aware of what's going on. So, for example, if there was a breach on the code of ethics and someone had a personal trading violation, and they forget one, maybe not that big a deal in the grand scheme of things. If they do it 3, 4, 5 times, you've got my attention perhaps. And now we're going to get your manager involved. It is a management issue. It's not just a compliance issue. It's a management. It is their issue. One of the big things I want to make sure, and I'm sure everybody else in this room here wants to make sure, is that I don't want to be their supervisor. I do not have the ability to hire or fire or change compensation. I will make some recommendations, but I do not have that ability. I do not want to be a supervisor. It's a management issue, and we're going to make sure it's dealt with in an appropriate way there. But in the aggregate, remember, I still have obligations to report up to the board. I probably think I'm the only one here. I have a dual reporting relationship. All right, so I'm different than probably everybody else in this room in the fact that I actually report to the board. Okay, they pay my compensation, that part of it. I also have a line into the management company, so I actually have a dual reporting obligation. Okay, so I take that, obviously that role as a direct report to the chairman of the board very seriously. So we give them a full transparency as to what do we see, particularly as it relates, I'm thinking about back to the code of ethics. I'm not talking about every little nitty potential break on the investment monitoring side, because most of that is a little bit of noise. But if there's something systemic, they're going to hear about it. That's the order of magnitude, I think, that you need to make sure that you're dealing with when you're talking with your fund boards and those kinds of things.
I was just going to speak specifically and talk about how to deal with a breach. So obviously it will depend upon what particular process you're talking about. But to use an example is trade errors. So obviously everybody has to have a method of overseeing, identifying, and dealing with trade errors. So again, just using that as an example, the way I would look at that is there's 2 ways to keep an eye on it. One is going to be basically the self-reporting, the person who is involved in the error knowing that they have to report and feeling that obligation to report. And then there's the need for there to be a top-down oversight. And I think it's important, and I think it is the practice to kind of have both elements of that. And I think this was already mentioned earlier about empowering people, having the right culture, educating people, and making sure that they understand their responsibility and understanding that it's in their own best interests, as well as in the firms, to self-report. They want to get ahead of these things. And we do, when we deal with things like that, when people self-report, we don't punish people for self-reporting. And in fact, we appreciate it and we express that appreciation and we use those as an examples to communicate throughout the firm. This is the way it's supposed to be handled, because if we're the ones who identify it, rather than you self-reporting it, it's going to be treated very differently. But then at the same time, we do have to oversee it ourselves. And there are various different ways, and there is no one-size-fits-all way to deal with monitoring for things like that. Again, just to use some examples, we can monitor investment performance, we can monitor allocation of trades, we do independent email review. There are a lot of different things that we can do from the top down to monitor for errors. So it's the confluence of those two. I believe, I feel fairly confident that our process is reasonably designed to address that risk. And then, of course, there's making sure that you have the right procedure in place to deal with it when those issues arise. So again, using trade errors, we have it as a written policy, but then it's implemented in practice. First of all, you identify an issue, and you have to look at it and say, okay, is this really a trade error? And you have to understand the facts to make that assessment. And then you have to deal with it. Let's say it's a trade error. You have to make an assessment of who's responsible for that, for the cost of it. Well, you have to actually quantify the cost first. Then you have to assess who's responsible, which is going to be dictated by policies and disclosure documents. You have to track it, because you have to be ready to speak to someone who asks you, especially if it's a regulator who wants to see your log. And at the end of it, you want to be more proactive and think in terms of, well, what can we do to mitigate the risk of this in the future. In some cases, you're going to look at it and say, look, this is just a risk. This is just reality. Fat fingers is a possibility, but it can, it can still be mitigated with technologies, with redundancy of systems and things like that. Or, there are other ways that you can, at a higher level, mitigate and reduce the likelihood of that particular risk occurring in the future. And again, but that's just an illustration. I think different risks are really dealt with different ways.
Yeah, and to be fair to my firm, I was speaking broadly more for your perspective that, I think on the big errors we're going to, do whatever's best in the interest of fund clients. But we have, our CCO actually does report to our boards. She has the ability to fire. She has fired people for issues. We have the oversight. It goes back to the human capital issue that if you train people and tell them you can come to us, if we get ahead of an issue, it's better than being behind it. That's great. But if there were, I haven't come across the issue, but if we had a massive problem, you're going to do we're fiduciaries, right? So we're not in the role of being, I guess, self-regulated in the sense that, to do what's best for the system, we have to do what's best for our fiduciary clients. So we're always going to take that stance.
Great. Warren, you're a very patient man. There you go.
All right, if we can maybe turn to the schematic we provided, I think some of the discussion around testing of policies and procedures is built into the 40 Act. Down in the center middle, we've listed just a sample of the primary SEC-regulated fund protections. As Todd mentioned, the CCO role is a formal role, a regulatory role. There's a requirement in 38A1 from the fund's perspective and in 20647 from the advisor's perspective to have these policies and procedures in place to ensure they're adequate to maintain compliance with the regulations, to test them on a periodic basis, and to report out on an annual basis to the fund's boards. So maybe I can lead into you there.
Yeah, and that's as you might imagine, a very, very elaborate process and something that, quite frankly, I think the board looks forward to every year. And generally, it's about a 60 to 90-minute presentation similar to this that I do to the fund's board to review the results and go over and answer any questions that they have. And certainly a good component of that is done in executive session, which means it's literally just the independent trustees, not the interested trustees, and myself. And it's a very frank and honest conversation.
I think, getting, back to the basic, on a basic level, I think, and I think Dov essentially said much of this is that you see a problem. Well, first of all, as far as the testing, you're in a constant state of testing. And, I created, and back in 2004 when I didn't know anybody else who had this, but now I think everybody has it, and they didn't copy me. An automated compliance calendar that spreads things out throughout a yearly period because, the rules technically, and the SEC rules, Advisors Act rule and Investment Company Act rule requires an annual review of your compliance program. The NFA self-exam questionnaire is also an annual thing, and I view that sort of as the same thing, really, if you use it right. So this idea of an annual review, well, if you save it all for, now, well, then you're never going to get it done in a meaningful way. So you spread it out over a period and you figure out a way and you look at the challenge is identifying every issue that you think needs to be addressed in your policies and procedures. And even if it's not there, identifying other issues that you didn't necessarily write up, but it's an issue or it's something worth testing for. And then you use both subjective and objective ways of identifying those issues. And then you think of spread throughout the year a way of testing each one of those issues. It can be a technical way of testing an issue, and you can call it forensic testing, or you can call it just testing. It doesn't matter what you call it. We tend to get very term specific, but I think, I was just discussing, I plant names in order to check our AML testing. So I plant names in our client list and see if they catch them. If they don't catch them, okay, so if they don't catch them, that was a good test. If they do catch them, that was a good test. Why? Because now I know there's an issue. So my testing is really an analysis of trying to discover problems that aren't necessarily discovered otherwise. And so you take both types of problems. You analyze the problem. You say, okay, what is the problem? What's the nature of the problem? And first of all, first in my mind is, okay, is there a resulting harm to anybody? A lot of the time, it's a technical violation of a rule or whatever, not to minimize that, but hopefully there's no harm to an investor. If there's no harm to an investor, you immediately, raise it to a different level and you try to figure out how to deal with it in the best way. And so you want to correct any damage first and foremost. And at the same time, or immediately thereafter, you want to fix the problem. And what I mean by fix the problem is not say, okay, put this Band-Aid here. What I mean by fix the problem is I view it as a personal failure to a certain extent, not monetarily, but otherwise. If my policies and procedures, which I own, it's my baby, if there's a failure of those policies and procedures in some way. So I want to think about, okay, why did it fail? And usually my conclusion is, well, nobody here wanted to do anything wrong. It doesn't seem like they didn't benefit personally in any way. They just messed this up. So how can I either fix my policies and procedures, or if they don't need fixing and they were right, how can I educate people better? So part of my testing is I'm constantly checking people's reading comprehension. It reminds me of the SATs. You can write it and people can read it, but it doesn't mean they understood it, and it doesn't mean they comprehended it, and it doesn't mean they're doing it. So part of your testing is geared towards that, and then the challenge is to make sure everybody knows about it. And so you just think of creative ways to educate people in order to make sure they understand. So I use, notwithstanding my earlier reference, I use Seinfeld characters. I use all sorts of things. I just randomly ask questions every once in a while that they have to answer. I offer a prize for the first few people who get back to me and get it right or anything like that. I want to see if people understand what it is that they have to do. And I find that solves a lot of the problems, because most of the problems we face are not problems of people stealing money, and those problems we know how to deal with. Those problems, you call the regulators, you call the people, you make sure they're in trouble, they're gone, that's it. The other problems are a challenge to identify, and really you don't want to get anybody in trouble for them. You just want to fix them and get the right people in place and the right people on board. So again, like I said before, it's not a gotcha kind of testing necessarily, and you enlist other people to help you do this testing and to help you discover things. So for the sole purpose of you being able to fix it. And I think that's really a focus. I definitely have an opinion on how people are supposed to view compliance and how it's supposed to work. And I really do think of it in the way that I described. And I think that in that sense, it helps you find the risks, address them, mitigate them for the future. And then, as the SEC is so fond of saying in their compliance rule, identify, detect, and then correct. And that's really the process that we're going through. I applaud that SEC rule. I don't often say this. I think it's a good thing. I think that they got a principles-based approach in which they said, okay, you hear it here. We all have different approaches to everything. And my policies and procedures would be entirely inappropriate for the Vanguard Group. They would be completely, off the board, horrible for the Vanguard Group. But they're right for us, and they're tailored for us. And to have a specific rule, to have a specific idea as to what every place has to have is just foolish. I think to have this kind of principles-based approach where everybody is mandated to tailor something for their firm or expected to do something, which I think is currently the case, that I think that's the right approach.
Thank you. One thing that I was going to add, because I feel like there's a little gap here of there are no smaller shops represented. And so I'm speaking for them only because we're investors in some of them. The issue of policies and procedures, we have tons of them because they're a big firm. But for some of the smaller shops where it's 4 or 5 people, there's no sense in having that many documentation because they all work together and they're all monitoring each other. And what they often do is rely on outside help to monitor what they're doing. And I want to make that clear because there is an industry, a consulting industry for compliance and legal services. Many of those shops, they're small, but they actually are managing significant assets and often of big institutional investors. So they can't afford to hire some of the big top name law firms to help them with compliance and their monitoring. So I want to make clear that when we're talking about these extensive, policies and procedures books and risk matrices like dashboards that we do, we're taking into account those smaller shops that have no practical need for that because it's five guys who speak to each other. And so they work together, they understand and communicate about the risks, and they have outside help that comes monitor their efficacy, or if they have a breach, help them understand where's the harm, how do you respond to that. I just want to make sure that perspective is not lost.
I think probably just since the discussion is with the commission, we were focusing a little bit about that structure of the 40 Act and all of the good things that we would talk about within each other's forums and as manager of managers or fund of funds. But when it comes to the overall industry, I think we wish that everybody were a good actor. I think we've got fantastic people on this panel. But I think the 40 Act protections and the fact that there are requirements as opposed to just good practice is one of the distinctions. And I suppose that the sort of coming up with a set of them, whether it's the idea that we have to have portfolio transparency on a regular basis, and we've got daily mark-to-market valuation, so you've controlled that fluctuation, that NAV that's published. The liquidity requirements that are built into the fund structures so that the investors know generally what kind of liquidity they should expect with their funds. Everything, limitations on leverage is another thing. I think leverage was a significant concern, especially when we talk about commission and the products that you regulate. There are limitations on leverage for our funds. There are also requirements for when we do use derivatives, what we have to do to segregate assets to cover those derivatives positions. The independent custody or the third-party custody of fund assets, and I suppose that check and balance between the trustee records, the bank custody records, and the firm records is an important distinction. Prohibitions around affiliated transactions. So again, that goes to sometimes the conflict of interest or the incentive structure that's in place. And that oversight by an independent board of directors with the CCO requirement is I don't think we need to underestimate that one. It is, again, a requirement, not a nice to have.
And the one that we haven't talked about here, at least in particular to the 40 Act, is the role of the independent auditors. And certainly the PCOB has raised the stakes for them over the last few years. And so that is an additional control that we have that is certainly required to review each one of the portfolios and actually do a lot of forensic testing on the valuations. And one of the things they're having to do right now is to actually go and back and do fundamental analysis, particularly on the credit side, to come up with a derived price to make sure that it agrees with the pricing vendors. And certainly we are not in the position as a fund shop just to be able to rely, unfortunately, on the pricing vendors to give us a feed as to what the actual price of a security is. We actually have to do that ourselves. That is, under the 40 Act, solely the responsibility of the board. It is delegated to the advisor. We hire pricing vendors, but we have to make sure that it is correct. And then, so what I was alluding to, the independent auditors come back and actually do an independent calculation on a number of securities, not just one or three. It's a very large number, and they will pick a fund to go through it on an annual and semi-annual basis. It's very strenuous, very strenuous.
I just want to point out that, I think it's important to draw a distinction here a little bit between if you have we were talking a lot of these things that were mentioned just now, some of them are just to make sure that we see the distinction. Some of the protections that were mentioned just now are Investment Company Act of 1940 things, and some of them are also incorporated in the Investment Advisors Act of 1940, and some of them, interestingly enough, are only in the Company Act and not in the Advisors Act, and there's a reason for that. It's not, to the extent the SEC in making Congress and then in making in various acts and what they incorporated in what and what they continue to incorporate in which, and the SEC in terms of their rulemaking, and certain rules apply to certain types of entities depending on the level of risk there is in those types of entities. And I don't think we should go so far as saying that just because there are all these protections in the 1940 Act, well, the CFTC should look at these protections and incorporate the same exact protections. And the CFTC has the same exact approach in terms of, well, if you have pools that are exempt or pools that are 4-7, which is not exempt but not subject to everything, and you have things that are just no exemption. There are different rules and regulations and things that apply as appropriate. And I don't, while I do think there is a certain structure. So I think my point is that the CFTC rules and the NFA rules also do address most of these concerns to the extent they need to be addressed in that context. And I don't think I don't think a wholesale incorporation of the Investment Company Act of 1940, applying it to commodity pools would make any sense.
Okay.
I think the NFA and CFTC have thought about the protections that are necessary and incorporated them.
Okay, so we're sort of out of time, but I really quickly, and Warren, did you have another word? Because I know you've deferred out. You want to real quick, just quick final statements, but then we'll move to the fund of funds topic.
Yeah, I think my comments and the pointing out the protections in the 40 Act were not as a suggestion to the CFTC of what you should do.
We didn't take it that way.
More of, just the opposite.
I just wanted to be sure.
A risk guy, a compliance guy. Yeah, got it. Anything else before we switch topics? Okay. Okay, so now we're going to move to our second session and talk about fund of funds. And I guess we'll just start it, given the fund of funds unique situation as both an asset manager and as an investor, how does your risk management differ from the rest of the direct investment funds?
All right. So speaking from the NQ Hedge Fund Solutions standpoint, like you said, you have to, I guess, break it down between two different separate topics. Looking at it overall, we have an internal risk group, and then we also have a risk committee that is external. And so the risk committee is responsible for reviewing the overall performance, how funds are performing well within expectations, if our products, which is what we call them, not to confuse them with the hedge funds we invest into, have any of their own violations of guidelines that may be in the offering docs. Those would be raised, and they would look to, identify were those passive or active breaches, and what kind of time frame do we need to correct that. Nicole had touched on the fact that there's an internal audit group within UBS that will come through periodically to do reviews. And then we also have people who sit on the various different committees. For example, I sit on the investment committee, the manager approval committee, the management review committee. We also have the risk committee. I sit on that as well. We're a bank. We have a lot of committees. So that's a part of the mosaic that he talks about understanding people talking to one another. The way we're actually set up as well is trading desk style, which means like this, everybody sitting around each other, all the different groups, investments, OpTD, investor relations. So it's a very open forum. So if issues come up, we can discuss those and address those. Similar to what other people said as well, we have a compliance culture that is, if a issue does come up, raise it and let's figure out how to deal with it. The other side of the equation, I guess, is when we're reviewing the funds that we're in, the investment team, we talk about expertise in the culture. A lot of people on our investment team actually have trading backgrounds, or they've been chief risk officers at hedge funds. We feel that's an important thing to be able to understand the people we actually invest into. On the operational due diligence side, some of us were former CFOs, chief risk officers, controllers, people came up through the industry. So hopefully we understand some of the issues that the hedge funds face. We understand that things don't run perfectly every single day. There's problems and errors that come up. That's the reason you do reconciliations and train people. And what we want to understand is their culture. How does that impact them? And something we would follow up on. In addition to that, transparency has become a more heightened thing in terms of understanding the risks that are running. As a part of the investment process, we try to understand what kind of performance do we expect out of them, what kind of volatility do we expect to come with that performance, and a whole lot of other statistical data that's probably not worth going into this. That's very a little bit more complex. But at the end of the day, it comes down to, is performance in line with what we would expect relative to indexes and peers? Is volatility in line with that as well? And is their return relative to that risk in line with what we're investing in? Okay, so that's a high level. The other thing we do is we want to understand from an operational standpoint, are they doing everything we've talked about? So our approach, like some of our peers, is before we make an investment, we go on site and we want to sit down and we want to meet them, look them in the eyes, look at the offices, and it depends. If we're going to talk to a large firm, we'll talk to the COO and the CFO, but we also want to talk to people who are in the back office who are actually doing the day-to-day. If it's a smaller firm and it's got the 5 people, we'll probably meet with all of them, and that's fine. And that's where we will try and impress upon them that we understand they may not have all the control infrastructure a large firm might have. But what they can do is get as many pieces in place to mitigate problems. And as we've touched on before, that's where the third-party service providers come into play. That's where the independent administrators are much more important, because we're going to place more reliance on their controls and have them involved, which may mean they have to sign off on the movement of cash in addition to what might be going on within the fund. We're going to be looking at them to look at the valuations much more closely. Here where we're talking about funds that fall under the CFTC, many of these happen to go through exchanges, so the valuations are a bit easier to deal with. But you could also have things that might be forwards that they have to do some kind of correlation analysis. We spend time looking, and the other thing we do is we do an on-site review about once a year as well, and we cover all the same topics that we covered in the first time through, and we want to understand how things have changed. What we don't do is ask, has anything changed in the past year, and have them say no. What we do is we actually walk through everything again, right? And then our approach has always been, if there's something they're doing which we don't think is as strong as we need it to be, that's where we'll have suggestions and we'll work with them. And we'll say, example, maybe only one person signs off on cash. You know what, guys? We really want to see 2 signatures. We want to make sure that at least one of those signatures is somebody in the back office, if possible. It could be a situation where the portfolio manager is valuing the securities. And we'll say, no, what we want to do is have the administrator valuing. We want to have the back office to value. But we do want the portfolio managers to look at it to make sure it makes sense. So those are a couple examples. We have cases where we meet with the compliance people, and we don't feel like they have taken the responsibility as seriously as they need to. And that will be discussions we'll have with, one will convey that to the compliance team, but we'll also go directly to the CIO and the COO and say, we think we need some enhancements here. It may involve having to bring in a new compliance officer. It may mean bringing in additional people. And it's not the same answer for each firm. So if we were to talk about some of the really large firms, it wouldn't be uncommon to see 10 compliance people running around. Frankly, we would expect it. They have to. They're trading in all the different geographies. We have a small firm we're looking at now with 4 people. The COO is acting as a compliance officer. He has some background in it. I can't claim that that's his strongest forte. So what do? They work with some of the outside vendors. A few come to mind, and they could do it both in the U.S. There's groups like this over in Europe and in Asia. And we've spent time getting to know those service providers to make sure they really understand what they're doing. And what I will say is it's not uncommon for those service providers not to only help the small firms, but to also help the very large firms as well. And one thing they'll do is do mock audits, where they'll go through and test the controls. And one of the things that the smaller guys might get hit on first is they might say, well, these are our policies, but they haven't drafted anything. So we want to make sure that they've drafted something so that that's what they follow, and then have somebody test that, which is usually going to be one of the compliance groups. As a part of our process, we also will look at reconciliations. So we want to make sure that the trust but verify, the information they've told us is accurate. So show us that the values you have is consistent with what your pricing sources say and with the administrator and the prime broker or FCMs. Let's make sure that the positions you claim you hold actually tie back to the custody records. Let's take a look at cash controls and look at reconciliations. So I can't claim that we do a full audit. We don't. That's not what we're hired to do. We're much more from a consulting perspective, but we think that we're able to do a process-driven but risk-focused approach on the funds, and it's continual monitoring. And like Greg had said, understanding who are the counterparties, who are the FCMs. If we hear of a potential issue in the industry, we want to understand what are our risks, what are our exposures, and we may talk to different firms and say, how are you assessing the risk with your different counterparties as part of that process? So that's kind of a high level of how we look at it, from the top down, and then at the funds that we actually invest into. But it's a continual process, and we do some risk assessment of who we consider to be riskier and who we don't. I can tell you this, we're invested in over 200 hedge funds right now. I've probably looked at 1,500 hedge funds since I've been doing this everywhere. If I was to say what is best practice across the different categories I hit on to begin with, I've probably got 5 hedge funds that can actually accomplish that, okay? So the best practices versus the bar to actually, meet our standards are different, and that's fine. But we think it's really important to be able to invest in both large hedge funds and the new guys who are spitting out, because we think they offer different opportunity sets. And so we consider that when we, create our portfolios.
I think our process is very similar to what UBS does, so I don't have a ton to add on the granularity of what James was saying, but I do want to point out one thing that I think is implicit in what he was saying, but is just critical to keep focused on as you think about the difference between our business and the direct trading business, which is we are one step removed from the asset, right? And so as you're thinking about the processes we do in building these, tracking indexes to judge whether the managers are doing what we expect them to do. And again, I want to make really clear on this. Risk isn't a bad thing, right? You have to take risk in order to have return. It's whether the risk you are taking is within the expectations that you've set with your investor base. And so what we're constantly trying to do is on a month delay, because that's when we're getting final returns reported and whatever position transparency we would get reported. And I think this is one part of risk that may not have been talked about a lot. For a significant percentage of our portfolio, for 80%, more than 80% of our assets under management, we either get position transparency reported to us directly or through a commercial risk aggregator. So there are third-party risk aggregators out there who, if a hedge fund manager isn't comfortable reporting positions to us because they're concerned about our acting on that or doing something that they wouldn't like, they report it to a third-party risk aggregator who is not in the markets, and that aggregator in turn reports to us with less transparency than at the position level or on an aggregate basis with other hedge fund managers, so that we can't slice and dice down to the position level. My point being, that comes to us on a delayed basis, right? And so in some respects, it's a little bit like the reporting the regulators get. It has to come through on a delayed basis. And so you're looking in the rear view mirror a little bit on all of that stuff in terms of understanding if your expectations were being met. And then we are having monthly calls with the managers we invest with, going over how their returns may have differed from what our expectations were, or what the primary drivers of return were, and what areas of concern are arising for them in their portfolios. So the challenges in our business of being one step removed and being delayed and evaluating risk in terms of what happened, and then rolling that up to our portfolio level and saying, okay, what do we think is going to happen in the future, and how are we running our portfolio analytics? And at the same time, recognizing that the direct trading managers need to be constantly changing positions and need to be constantly changing their risk profile, and adapting to that adds a level of challenge to this that I don't think we can kind of understate, and makes it really difficult for us to be as real time as possible when we think about things like regulatory reporting. And I think we've written some comment letters to the CFTC about the challenges of responding to reporting within a certain time cycle, just because these guys have to do their job. They have to get their NAVs published and their information together, and then they have to send it to us, and we have to roll that up from 200 different sources and get a conglomerate from that. And then we have to produce a report that goes to our investors and to our risk management committees and things like that. So I think the process is very similar. I just want to make clear that delayed aspect of it introduces an additional level of challenge that you don't have when you're interacting directly with the asset. So,
And that's what I actually would view as the difference in a fund-to-fund versus a direct trading fund. So if you look at the schematic we put together, we had said, the 5 general risks, which everybody has talked about. All of those risks apply to everybody, but the issue for us is that investment risk is on a delayed basis. We don't have position level information. And so we need to do everything that James talked about to try to get in front of it as much as possible and try to get as much information as possible as we can about all of these risks without having that position level information. And I think that's where the big difference is, because something like liquidity risk, sure, we're intermediaries of liquidity, meaning our investors get certain liquidity. Our portfolio doesn't 100% match that liquidity. That's the point. There's different strategies in the portfolio. We have to worry about making sure that the portfolio can match the investor's liquidity. Direct trading funds have to do that as well, right? They could give investors monthly liquidity and then put private equity investments in there and they just blew the portfolio, right? So they have the same concerns about everything else. For investments, for us, it's just the delayed aspect of it and the lack of transparency on a portfolio level basis. Having said that, as fund of funds and as allocators, our job isn't to build a portfolio of positions. Our job is to build a portfolio of hedge fund investments and a portfolio that works together. And so from our perspective, it's an issue about minimizing the risk of position level issues while making sure that our portfolio meets the expectations of our clients at the strategy level and at the allocation level.
I might just add one thing. I mean, we've talked about the rear view mirror a little bit. What I would point out, though, is many hedge funds provide weekly NAV reports or performance returns. So it's a little delayed, but you usually get it within if they issue it if they calculate on Friday, you get it on Monday. If there's big events taking place in the market, Crimea, right? You have a general idea of which hedge funds that you're invested in might be most impacted by that. You're not sitting waiting until the end of the month to get on the telephone with those guys. You get the portfolio manager on the phone that day and talk about what does the portfolio look like? What kind of changes might you be making so that we could expect that? And then based on those conversations, when the returns do come in, if those diverge, that's when you would have a follow-up conversation. So, you're not better. You're not blind. Your better transparency might be when you get all the aggregate data in at the end of the month. But, the way the teams tend to be broken down is people specialized or assigned by the different hedge funds. Their job is to understand what's taking place in those hedge funds so that the expectations of what we expect to see are either consistent or not. And based on that, you then decide whether to stay in the fund or not.
I was just going to make an observation. I understand the distinction you kind of drawn in this panel between the trading funds and the fund of funds, but I think a theme that is even broader, and picking up on something Emma said earlier, is that one of the good things, or what I find particularly helpful about this industry, is that it's an industry that encourages innovation, it encourages creativity, and it allows for a lot of differentiation. So I think that the spectrum is actually a lot more nuanced than just saying trading fund and fund of funds. There's funds that invest in equity and credit and commodities and all kinds of different things. And I think that it is appropriate for each one of those organizations to develop their own procedures, their own method of overseeing risk. To some extent, they're all going to be subject to certain factors. I think Greg touched on it earlier about the other participants in the industry, the administrators who are going to do their own function, the prime brokers, the custodians, the fund auditors, the fund boards. There are a lot of other external players that we don't get to control, and they're going to impose their own rigors on what anybody does, no matter the size of the organization. But I would expect, a three-man shop to look very different from a 200-person shop. And I'll speak in terms of our firm. The way we are today is not the way we were 5 years ago, nor should it have been. Our firm has evolved, and I think it's appropriate to expect that kind of differentiation.
At the risk of restating the obvious, I would say that in terms of our platform and other RICs, you can have fund-to-fund structures not related to commodity pool operators and the kinds of things. We also have multi-manager platforms. We'll have a fund with multiple managers on it. But the risks more related to lack of transparency and valuation aren't necessarily captured as much because of the daily mark-to-market evaluations.
Just to follow up a little bit on the points on liquidity and daily pricing. there is a big difference between if you're trading futures and forwards contracts that are priced, the exchange traded, at least in futures, and then priced daily. A lot of CTAs will do daily estimated NAVs, that are you could get by calling in to help with the funds and the other investors who are not who are not seeing the positions on a daily basis. So that helps as far as that type of disclosure. But also from a liquidity standpoint, there's a huge difference between what a lot of CTAs do and things like private equity, right? So as a matter of fact, in the 2008 credit crunch, a lot of CTAs, viewed themselves as being treated as sort of cash machines, because so much of the portfolio is segregated and kept in cash and can be used to meet redemption. So it does really make, to second Dove's statement, it really does make a difference who you are and what you're trading.
Going back to the interesting discussion about the managing the divergence between expectations and actual results. So as you're dealing with the okay, speak up. Okay.
I'm having a hard time hearing you.
All right. Dealing with the delay and some opaqueness, and then you're going through a commercial aggregator to get some information, getting what you can, and you're deriving some expectations. Then you're finding the actual results, maybe, and then you're on the phone with the fund manager. To what extent does that opaqueness? How much opaqueness is there when you've got your expectations aren't being met? You're back to the fund manager saying, what's going on? You're not telling me the exact positions, but they have to kind of explain what's happening. Can you?
Yeah, well, I want to be clear. I mean, when we invest with a fund manager who doesn't provide us position level transparency, that's intentional, right? We go into it knowing that we're not getting that and feeling very comfortable that we can still manage the risk of that investment. And when we do talk to the manager and say that performance was outside of expectations, I can't think of an instance where we haven't understood why that was the case. Now, it has occurred that when we've understood that, we have been very upset. I don't want to, sometimes you find out that a manager has engaged in style drift or done something unexpected. Sometimes it's hey, look, I had one position that just hit and it was unexpected, or there was something expressed through an options position and there was more implied volatility than realized volatility, or, there can be different ways exposure is taken that lead to different results, even though the positions moved exactly the way everybody thought. So, but there can be failed expectations. And when that happens, it is very typically a conversation with the manager of, okay, should we be thinking about your fund differently? Are we okay that you've now taken this big concentrated bet, if that's what's happened? If it did happen, are you planning on scaling out of it? What's your time frame? It isn't necessarily a fireable offense that someone has violated our expectations, but we absolutely need to know immediately what the plan is for either adjusting our own expectations because we have faith that the manager can do what they've now taken on, which was outside of our expectations, or that the manager is going to get back within expectations. Or the third choice is they say, you know what, Mesro, we appreciate that you have your expectations. We think the rest of our investors would be totally comfortable with this. It sounds like this relationship may be over, and that's when we, submit a redemption notice. So it's not, it is an ongoing conversation, and as firms evolve and markets evolve and positions evolve, it's not crazy unusual that these things happen and that hard conversations take place on the back end of them. And typically they're resolved to everybody's satisfaction, but sometimes, we part ways with managers because of it. So,
Greg, I'd imagine that those gaps between expectations and results are probably not that are fairly atypical, because from the fund perspective, who has these investors, it's not a good business model to not be transparent to not be ahead of the curve, to not let people know, hey, here's what we're doing. So I'd say, for the most part, forgetting, risk management or what we should do from a just pure business perspective, people are going to communicate with their investors.
As someone who's spoken with a lot of your colleagues at both of your firms, I'm well aware of how the frequency, the level of understanding of our client base, and the expectation that what we've said we're set out to and said we were going to do is something that we're going to follow through on. And if there's deviation in any material or immaterial way, our clients are really the first that are going to want to know about and want to understand and be able to interpret that to their end investors, to their boards or constituencies. So I would say we're very aware of what any deviation from sort of what we've set forth in our business model and business practices might do to our client base.
And to clarify something that might not be apparent to somebody that doesn't look at our systems, the reason why we can set expectations, even without position level information, is because before we even make the investment, we have a quantitative process of benchmarking what we expect from each managers, given the information that they've given us, whether it is position level information or risk reporting from the aggregator or specialized reporting that the manager provides to us that's not position level, but it's robust enough, and other market benchmarks. And so before the investment is even made, we have a benchmark that we say, this is what we expect from the manager, and this is how they have to perform. And so that's what we're constantly comparing them to. So we're not comparing to position level information necessarily, but we are comparing to a benchmark that the manager himself set for us and has agreed to, and that's where we have those sort of discrepancies that we can go to the manager.
How does it translate to your investor base then? So there's kind of there's in some way what I'm hearing is sort of there's a time lag and some opaqueness, but it's not that serious because you kind of get there anyway because they kind of have to get you there. So I don't know really how much there is, but ultimately you have to translate that. You can be comfortable because you live with it. How about, does it change the nature of your investor base? Does it take us more of an education process for investors? How do you deal with that end of things?
I'll go. Yeah, I can talk about it. Yeah, so one of the things we do when we are speaking to potential clients is one, understanding what their level of risk is. We offer a variety of products, making sure that they get into a product that makes sense for them. In many cases now, we're actually creating a new product that's just for them with their own guidelines. Okay, and in that it covers a variety of things from expected risk, performance, to volatility, to number of positions that might be in the portfolio, to the different types of strategies. Depending upon the client, some want to get updates monthly, some quarterly. I think one thing that's worth highlighting where we are different from the mutual funds is nobody's coming into a fund of fund or a hedge fund with daily liquidity expectations. Okay, usually it's monthly, quarterly. We have some that could be annual, right? And you try and build a portfolio based upon that. And I think one of the things we look at, when we're looking at the returns, is does it make sense with what's going on in the marketplace? At the end of January, nat gas was going crazy, right? So you'd be speaking to the natural gas investors that we have and understanding, did they make money? Did they lose money? And then really understanding as best we can what positions they had on and where they're playing within that part of the curve. Because, not only is it understanding, why did they make money, but does it make sense? Is it consistent with our understanding of what they have? I can tell you we have different types of investors that want more drill down than others. Some, want a lot of detail in terms of how do they make money, where do we see things going a couple months out, and how that might impact their portfolio. We have some who are perfectly happy they'll get the updates, but it's really once a year that they want to know what went on in the portfolio and how did that fit into their overall portfolio. Many of our investors are big institutions or endowments or pension plans. The reality is their allocation to us and to hedge funds, the alternative piece, is 2%, 3%, 4%. It's very small, right? So, it helps in terms of their overall portfolio performance, and based on that is what they're looking for. What we do provide I think it's accurate to say we provide all of our investors with some kind of monthly report in terms of how they performed and how those strategies performed. And then, depending upon how the relationship was established, some will get, more frequent feedback from us. So both on site where they come to meet us, and then in many cases we'll go on site to meet them.
That's right. I mean, the answer is it depends on what the investor wants. There are investors who are content with a monthly report of performance, and there are investors for whom, before we would put a manager in their portfolio, they want basically what I'll call a mini due diligence report that outlines who the principals are, how we expect the strategy to perform, what we think the principal risks are. And they want to know a lot about that, what we think the performance profile will be. And then we're having monthly calls with that investor, walking line item by line item through the portfolio. So again, it's just, as we think about this risk management mosaic, if we don't get a great translation from the MKP team, as for instance, to us is what's going on in their portfolio, and translate that in a way that we provide our investors with confidence that we know what they're doing, we've all got a big problem in terms of the whether that investment will be ongoing. So there are investors who just want the snapshot, and investors who want to know exactly what they own all the way down. So.
Just on the issue of transparency from the trading company's position, obviously there's a balance because it's our intellectual property, right? It is what makes what does everything for us. So you have to balance the need for investor transparency with protecting the intellectual property, which you have to do, quite frankly, as a fiduciary for your clients. So you can. If there's if the fund of fund or the institutional investor is a big enough investor, they can allocate to a managed account, which can get them transparency. And obviously, all the CTAs who are at the end doing the trading just need to try to balance the need for making the investors confident in what they're doing with protecting their intellectual property. So it is. And there is some give and take on, like Greg said, can we give it to you a week delayed? Can we give it to So there, the groups do work. The CTAs and the fund of funds or the institutional investors work together to try to find the right balance for them and for their ultimate clients.
Yeah, I was just going to echo what Tom said. We don't require full transparency from the funds, and I would say in the vast majority of the cases, we don't have full transparency. But what we do have are various risk measures that we look at, that we receive from them. And in many cases, that's actually easier to understand because of the way they pair and group trades together that we would not be able to figure out based on full transparency. Unlike Mesro, who does work with a third-party provider, we don't. We have our own internal system that we've developed. They do many of the same things. So just, to make it clear, we don't require the full transparency, and in some cases we think that might actually make it more difficult for us to aggregate and understand information across our portfolio.
To do it internally, do you have to have information walls up, or how do you do that?
So our group sits separately within its own part of the bank, walls all around us, so total information barrier. We're on a completely different floor from the investment bank, the prime brokers, anyone like that. And all the information's kept in-house on our own, to my understanding, our own servers that nobody else has access to. We have a data team that actually has to sit within our walls. We had looked at the possibility of, trying to outsource that or insource that somewhere else in the U.S., and the bank was like, absolutely not. So that's why we have a data team that actually sits within our walls as well to pull that information together.
On the transparency issue, one thing I agree with everything they all said, and to echo a little bit what Tom said is it is a balance. So one way, first of all, when we provide greater transparency, we tend to do it pursuant to a non-disclosure agreement, and also what we tried to do is we tried to take a least common denominator approach to what we disclosed to. We were getting all sorts of requests for all sorts of risk metrics. So what we tried to do was take all the risk metrics we were being asked for, create a report that would provide that to all of the that would provide those risk metrics that combine them all into one report and provide that to everybody who's requesting the risk metrics. So that way, it's a sort of a uniform kind of disclosure to everybody rather than just to one individual or one individual place asking for it.
We're now going into our third session, and as it says in the agenda, it's about comparing experiences and best practices. I had an interesting conversation right before lunch, and so let me see if I can frame the issue and then throw it over to Katie and Dove. We were talking afterwards. So to start the conversation, thinking, okay, let me posit this group is great, they're good guys, but is there a concern about others who aren't doing all that should be done? Are you hearing the concern about the effect on reputation or a negative impact on investors who maybe didn't know to ask and there weren't good risk management practices in place? Should we hope for adoption of risk management programs? Should we hope for best practices, agreement on best practices worked out through MFA and ICI and others? I mean, is that a good thing? But then how do you take into account, is there an issue about cost of entry and freedom to innovate? And I was hoping that just interesting conversations and comments that I've gotten from Dove and Katie as we're going. So can I kick it over to you two to talk about your two sides of the conversation? Is that not fair?
I guess the first item really relates to what a particular hedge fund manager, hedge fund owner managers want their business to look like. Do they want to be a small 2 to 5 person shop with a very small, closely held group of clients, and they're comfortable with that type of business model, and they want to just kind of trade, perform, go about their day to day. But I think for firms that do want to see continued growth and gain stature in the industry, gain credibility with dealers, continue to hire ever and ever difficult to find performing portfolio managers, you really need to grow your business, grow your assets under management, and that growth really comes with the investor demands across the board. So, firms that want to evolve, want to become larger and have a bigger breadth, are going to really only be able to do that if they're willing to, meet the demands of their investor base. And so I think I don't think that there's a need to sort of impose something on these firms, because it's really part and parcel of their growth, and the way that they ultimately will only be successful is if they are kind of adhering to various imposed standards that are part of their business model.
Yeah, I would just add on that. First of all, just to set some context, I mean, to ask about whether there should be best practices almost suggests that there are no standards now, and then the question is, should there be standards? And I think it's already was mentioned earlier on in the panel that there are a lot of things that already exist in the industry that establish certain practices, such as, again, I'll repeat some things that were said before, the fact if you're regulated by the CFTC, you go through the NFA self-exam. If you're SEC, you have the SEC's annual audit. You have your funds will have external financial audits. You'll have boards of directors that bring their own rigor. You have your administrator, your custodian, all these participants in the industry that frankly, it is already the case that anybody who's in this industry and who's operating in pretty much what the standard process or structure that any hedge fund, no matter how big or small, is already subject to a lot of these things that have been established in the industry for very good reason, and that they largely accomplish a lot of the things that you would think you would want to be accomplished with best practices. Beyond that, I do think that there there needs to be room for creativity, for innovation. The industry is what it is today because 10, 20 years ago, a lot of smaller organizations were able to start, were able to succeed and to evolve to where they are today. And there needs to be that constant, new blood being brought into the industry. Frankly, there's a higher barrier to entry in the industry now than there ever has been. And it already sets a very high standard. If you want to launch with the kind of assets under management that you need to be successful even from day one, you're going to have to meet the market demands that are much more rigorous than they were, say, 10 years ago. So those are kind of self-imposed, whether it's from the businesses who know what they need to do in order to succeed, from the client base, the fund of funds, or and obviously not just the fund of funds, institutional clients using consultants are also very demanding these days. Even if you go to the high net worth, if you're on a platform, private bank platform, those platforms are similarly very demanding. So I think that there is already this, all this is imposed already on the funds of all sizes.
Let me just add one other element for your consideration, just to throw it out as it occurs to me. So we know we're in an environment where, whether it's due to Volcker or Basel or whatever, that there will be, to the extent there's a move of risk, for instance, from banks to the less regulated space, to the unregulated space, there will be an increase in risk there. It's just a hypothetical or theoretical question, but so you'll be new players and different strategies and things that will absorb some of those things that get shedded. So is it another consideration to think about, okay, here comes more risk, we can either wait until after there's a problem and then you see a reactive response to it, or is there also a benefit for industry to have a focus on risk management and to incentivize some of that for, obviously it doesn't affect you, but for others, is there also another reason to do it? So, and how does that play in, I guess? So you've got, on the one hand, if you want to be a large player, the investor side, I guess, and the other considerations are going to force you there, versus the desire to have room for creativity. And then I would just like to throw into that mix, and what about the idea that there's going to be changes in the fund space as there's a sort of a structural change of some things, I don't know what, but out of banks and into seeking a less regulated space. Is that any kind of concern, and should that be any kind of a consideration on whether industry wants to get ahead of the space, and is this any way to manage that risk? Is that something that should be considered?
I would just I would say, to echo what Dove said first, about there really is a high barrier to entry now, right? To and that is making it more difficult for people to get in, but it's also making it more difficult for people who aren't risk focused to get in, right? And I would say that some of the things you've heard, particularly from the fund of funds folks, the industry, the market has on its own adapted to what's going on. I mean, almost very quickly after the Madoff situation, we've been in business 40 years. We've been self-administering, doing our own NAVs. We were an SEC registered transfer agent. We immediately started to get pressure from selling partners, and from in particular, especially selling partners who sell to accredited investors, that they simply were not going to be able to accept firms that were that are purely self-clearing anymore. So the marketplace is driving this focus on risk, and it has been happening. So I do think everybody says we're all always fighting the battle of the last crisis, and I think that the market does react to it more quickly, and I think the market has reacted to it relatively quickly.
I'm sorry.
Just to clarify your question about Volcker and Basel, are you trying to get at if hedge funds fill the gap of the more illiquid, or sometimes they're called riskier, but let's just say illiquid assets that banks are pulling out of? if hedge funds get into that gap, does that increase the risk to portfolios? What sort of risk are you trying to get at? Just to make sure I understand.
Okay, I mean, I'm not even sure it'd be hedge funds per se, but you read about funds set up to invest in portfolios of loans because when the banks weren't lending enough. Is that a hedge fund? I don't think so.
So your concern is that the risk in the portfolios is increasing because they're filling that gap now.
But the risk to the investor then is if there's not now appropriate diligence, is that a risk? I mean, if your concern is that there's a blow up in a space and then there's a regulatory response or there's an investor reaction, is it something that people want to get is that a reason to try to get ahead of it? Again, through industry, I'm not proposing anything, I'm just, or not, just putting that into the considerations about barriers to entry versus loss of creativity. I'm just saying we're also in a period of shifting markets and, to some extent, there will be new types of risk that come in and they're not you folks and maybe they don't have the same, but you might be impacted by the same kinds of considerations to damage to the market, damage to the investor base, and so on.
Yeah, and I think, if you look at the impetus behind the Volcker Rule, right, it's to move risk off of banks' balance sheets to decrease the risk of failure at a bank. And one thing that I think I just want to point out in terms of the risk implicit in some of that trading activity is going to hedge funds, and hedge funds are finding it a very profitable space to get into because as the banks shrink, and this is a real danger to the markets from my perspective, and we see it in what goes on at our underlying managers, the number of sources of liquidity are decreasing, right? So as banks merge, as banks get out of businesses, you used to have 10 market makers or 10 possible sources of liquidity. Those are shrinking, and so different parts of the market have to start supplying those. And if there are fewer suppliers, spreads are wider, there's more profit to be made there. But then that comes out of somebody's pocket in terms of the wider spread, right? But one point I would make out in terms of hedge funds don't have leverage implicit in their balance sheet or a balance sheet where they can write that leverage from, like some banks did, right? So they are often, if a hedge fund is going to get leverage, it has to get it from somewhere, right? They don't magically have this balance sheet that creates that. So there is an inherent break through the counterparties they're interfacing with to get that inherent leverage, right? If they're trading futures contracts, it's through an exchange where exchange trade margin is being required. Swaps contracts are now headed the same direction. So, and if they're getting leverage from a PB desk, the PB is assigning risk weights to that and putting the brakes on the amount of leverage that can be inherent in those trading structures. So it is different in terms of kind of the unmonitored risk that goes on, again, for some of the reasons we talked about in kind of the third-party check space. Those are inherent in the relationships hedge funds have set up as they go into this business because they need sources of capital to do that. So I hope that makes sense, but I think it's from a market risk perspective, it's different in kind because you just can't see the levels of leverage due to the places that leverage has to come from. From an investor risk, Dove pointed out that there are, because these aren't regulated investments, a large brokerage firm doesn't just throw open the doors and say, hey, everybody who wants MKP, come get MKP, right? There are only certain brokers at that who are allowed to sell it to only certain types of clients, and only after the broker's due diligence team has completely gone through that hedge fund manager and done a similar due diligence process to what we described. So there is the gatekeeper function that's still in play, and the minimum levels of investment that are required to access a hedge fund serve as a deterrent for anybody to do anything but go through a gatekeeper or apply extreme due diligence measures themselves to the extent they're capable of it. You're not going to prevent, and I forget who was talking about before, you can't legislate away fraud, right? There will always be some guy ginning up brokerage statements on an inkjet in his basement and handing them out to gullible people. Those aren't $1 million tickets, though, right? Those aren't even for the entrepreneurial hedge fund out there. So I think we need to distinguish those circumstances, which none of us in this room can prevent, unfortunately, from what we can monitor and can prevent. So I hope that makes sense.
I'll give you 4 different perspectives. The first relating just to what Greg said. When I was at the SEC, I had 2 different types of cases typically. And all of my cases were hedge fund cases. You had the Ponzi schemes, right, where you had people claiming to be a hedge fund they're going to figure out whatever the flavor of the month is, and they're going to be fraudsters. Or then you had the more systemic risk type of issues, be it insider trading, trading in swaps without, having real ownership, things like that. And there in 04, 05, it was the Wild West. We couldn't figure out who was who. There was no information, but that's changed. Which leads me to my second perspective, that at Halcyon, we've been lobbying since 1997 when we registered for mandatory registration. And now there is that. And a lot of it is just to identify the people because it is reputational. We're probably in the 2nd or 3rd inning of the institutionalization of our industry. We have these guys are our investors, and for the main growth, it's these guys, pension funds. The high net worth is really shifting towards 40 Act funds, and you see hedge funds, including us, that have 40 Act funds. There are still a lot of protections. So it's whereas in the late 70s, early 80s, the hedge fund industry was high net worth. That's not the case anymore. The third perspective I have is looking at what's happened to the CLO market. And, in the UK and in Europe, it's completely dried up, and corporate lending has dried up because of artificial rules and barriers created by the government. Here, there's a risk retention proposal that the LSTA and the MFA and others are fighting, and for good reason, given the fact that these aren't high fee models. They're people are already involved, but it's creating friction to new issuance. It's leading to concentration, and it's having an effect on corporate lending, and that's bad for the economy. And so that's now the final. Going back to Europe, you look at AIFMD and the types of legislation that are being imposed by the European markets, and it is killing the industry, and it's a really bad thing. I'm a pro-regulation, pro-government guy, but you shouldn't tell smart people that they can't negotiate contracts or agreements the way they want to. You shouldn't tell hedge funds how much leverage you can impose. We didn't create any of the problems in 07, 08, right? We're not 8, 10 times levered. If people want to come to me for a 5-year lockup vehicle doing purely illiquid litigation financing things, they should be able to do it. They want me to do a long credit, short CDX fund and create it, they should be able to do it. And that's where we come in, and that's what we provide. And now that there is mandatory registration, you can find us. But on top of that, to impose more layers would only stymie innovation. I mean, it's already, you cannot start up a hedge fund right now without a 7-figure spend on compliance. It's impossible. You used to have people starting with $50, $100 million. Now you need to have a successful launch. You have to have at least $400 million. And parochially, that's great, right? It's barriers to entry. That's good for us. But stepping back, it's not really a good thing for me as a person, because I want to be able to invest in and see innovation.
So let me not exactly push back, but distinguish a little bit. So let's pretend that we lived in a world where instead of Volcker, we had imposed risk-based deposit insurance premiums. And let's assume that instead of risk retention by owning some of the originated assets, we had the originators retain underwriter risk through reps and warranties that were required to be backed by capital or something like that. So instead of talking about those risks per se, we're still talking about then the people who invest in those risks, who aren't you, but new people going into the markets. So we're not creating liquidity risk by because you guys are arguing with the legislation. I'm not talking about legislation. I'm talking about people who are coming into the market to set up funds and taking on risk. And we're just talking about risk management. We're not arguing. I'm not trying. It's not just Volcker. It's 200% risk weighting of assets under, whatever, where it becomes less economic to hold it there and you move it. I'm trying to focus on people who are going to take on risk because there becomes a little bit more of an arbitrage to take it on in the space.
Right. So I can't speak about Volcker because I just don't know it. But I can tell you about risk retention. There's the underwriter proposal, which doesn't work because the banks don't. That's not what they're doing. They're not underwriting. They're just putting together the portfolio. And the problem to me in all of this is that we are saying this is the right risk management tool, instead of saying there are many different risk management tools. Let the investor and the manager figure it out, so long as people have the right incentives and the incentives are aligned, and we can monitor them, and we can enforce what laws are there. To me, that's the better way to go about it, because otherwise we're mandating that we know what the right risk management tool is, and it doesn't account for innovation. It doesn't account for the financial engineering and adapting to markets, which is really why people come to us. That's one of the best things that we can offer.
I have a thought as well. So when I look at it, one of my concerns about when you try and come up with, is there an absolute best risk management tool? Usually what happens is there's been a black swan event, as they call it, and you have another black swan event because you haven't thought about what that next risk is. So my concern is if people say, if you do A, B, C, and D, you should be able to manage the risk. And the reality is something always seems to come along. So that's one of my concerns. The second is if things do move out of the banks into the hedge funds or private equity or whatever vehicle, one thing I think the managers and the investors look at first off is, well, what's the liquidity profile that we're getting into? Okay, so let's talk about loans. Going into a monthly vehicle on loans would probably not be what happens. Funds that we look at currently that are doing loans and actually trying to fill in some of this gap tend to have annual to every 2 year to every 3 year liquidity, or it's a 5 year lockup with a runoff. So we then have to figure out how does that fit into our portfolio. The other thing I've noticed is generally leverage is down quite a bit from where it was back in 2008. When you talk about loans, those used to be done a lot on what we call total return swaps. That market is not in existence the way it was before. Generally, managers are doing everything with cash. They're not levered. So it doesn't mean they don't have risk. If any, they certainly are taking on loans that maybe banks wouldn't have stepped into that have some higher risk. They have to consider that with loan loss reserves on their books. But as an investor, that's something we're willing to consider as long as the liquidity makes sense for us and we can get comfortable with how they diversify those loans across the portfolio.
I think loans are a great example because if you look at UCITS versus the 40 Act, in a UCITS fund, you can't transact in loans. Now, I can transact in small cap bonds that might trade once a month, but I can't transact in IBM syndicated bank loan. So to me, the imposing these false rubrics of risk management because we view that being, that might be bank loan is risky, it's not really addressing the right question.
What I would add is I think the message is everything is different, right? But I think we have to agree that there is some baseline similarities, right? And I think we've talked all about them, and we can say as a baseline, some of the regulations, many of the regulations already require detecting and monitoring risks, however that applies to your business. And I think how we view when we invest and how I hope the industry views it is we expect each of our managers to have done that. And we ask about their risk management process in whatever form that is. So if you're thinking back on a best practices, I think what it is difficult for us is to come up with an answer for that. But I think we can all agree that it is best practice for generally a manager to comply with regulations that already require them to detect and monitor risks. So I'm not sure because I think we're all saying it's different, but there is sort of like a very basic baseline that, and particularly the risk we've already identified, investment, counterparty, liquidity, that people are already doing. So if it's a best practice as far as you should be doing this on an ongoing basis, I think we could all agree that there's a baseline, but the specificity, I think, is what makes everybody uncomfortable.
I was going to circle back to what I think you were starting your point is to say if banks are exiting certain investment areas and then and potentially hedge funds might enter or grow in those same spaces, whether that's a risk to be concerned about. And one thing I would, just to state the obvious, hedge funds are not in a vacuum. The hedge funds are not themselves putting up the capital. It's their client base. So really all it means is if banks, for whatever reason, whether regulatory or other, are exiting a certain asset area or investment space, so the question is if the client base of the hedge funds wish to get exposure to that space, is that a cause for concern? I would tend to say no, conditional on the fact that the hedge funds operate appropriately, that they make clear the risks that they're going to take. They communicate that to their client base, and then they stay true to that, and then the client base is going to monitor, just like everything we've been talking about all day, about how the hedge fund client base is actually fairly good at monitoring for style drift and so on. So for that new client base to replace the banks in terms of the taking on that risk, I don't see that as any inherent cause for concern that would warrant some, special action.
So I'm sitting here back, I'm thinking about the different businesses that are here, and Vanguard, obviously one of the largest in the entire country, and we've got me, I'll put myself as more of the large and medium size, but lots of other different sizes. And I think back also to some of the other shops that I've been at. And I think about the one thing that's common, and I think you're hearing it. We all do these things, but the most important thing that I think that you need to take away from all this is that when we do it, it's tailored so much specifically to our business. I will tell you that we're all in the business of taking on risk. Let's really be very clear about that. We take on risk for our clients. That's what we get paid to do, okay? But the one thing that's interesting here is that we all do this slightly different or vastly different. So to try and put everything, and I live the mutual fund world mostly, but to try and put us all into your space, it's almost not practical. Other than at a very high 100,000 foot level, you should be looking at this stuff. You should be thinking about what risk management means and compliance means in your shops. At the end of the day, these guys aren't going to allocate money to shops that, if you don't have risk management, you don't have compliance, you're not even getting past the first step. You're not going to, it's just not going to happen, right? So in thinking about from where you sit here now is, you want to see it, but the most important thing is you don't want to see somebody go into a consultant firm, getting an off-the-shelf policy manual and say, this is our risk management program, this is our compliance program, we got it, we're done. That's fool's gold, right? What you're hearing from the folks here is that if you want to be competitive, you want to stay in business, you want to keep your assets, you need to have it. You don't need a regulation per se. The market will force it. And even if there's a vacuum in terms of banks getting out of it, the money's going to go somewhere else, the same rules apply. The same rules of the market apply.
Transparency and fraud are the two main issues that, at least when I was at the SEC, that we were tasked with monitoring. And I think the fund industry, be it 40 Act, fund of funds, or hedge funds, transparency exists in the fact, differently than a bank, if you're a shareholder, if you own one share of Morgan Stanley, you don't know what the business is doing. If you own a limited partnership stake in a fund, you know what the fund is doing. You're going into it with eyes wide open. So that part of it is very different in our business, and as it comes to fraud, if people always ask me, investors say, how can I make sure that the people I'm investing in aren't doing insider trading? You can't. If somebody wants to do it, you can do it. You have to trust. And that's you really can't legislate around the really bad stuff that we want, that we would all love to be able to. So
But you already have. You know what I'm saying? There's laws against it.
Yeah, I mean that's what I'm saying. There's laws, but so you can't impose more to say, well, all this bad stuff happened over the past few years. We got to get to it. Well, people want to do bad things. They're going to do bad things. But our industry is a little bit different in that it is very transparent.
I think swaps are an excellent mechanism for managing risk, right? But when you start to build up a significant non-transparent unrealized loss position that can end up being sort of forcibly liquidated and becoming transparent and affecting the entire market, I think that's where you get back to maybe swaps should have been regulated earlier, right? That's something as Vanguard would have probably had a different opinion. So I think that trying to mandate risk management versus trying to figure out where the risks are that we need to manage and regulating according to those risks is probably another way of looking at it. The idea that the market will shift from time to time, that's going to happen. I worked at a prior firm that had a syndicated bank loan portfolio in a 40 Act fund. The disclosures on the fund were appropriate. The investments had to have a certain amount of liquidity. The structure was relatively complex, but the investors had expectations. Expectations of your investors on the hedge fund side wouldn't be for that amount of liquidity, for example, right? The sophistication of your investors might be a certain level. There's a requirement there. So the protections and the safeguards so that the entire market continues to function are really where we would like that continuing focus on regulation, and probably a little less on the firm-specific one-size-fits-all, which is not what you're advocating. But that firm-specific risk management approach is really difficult to kind of come to.
Other thoughts? I think you're fairly unified on this.
I think one last thing, maybe on the complexity side, I think I agree with transparency. Fraud is always a risk, but I do think that sometimes the complexity of the things that happen in the financial markets get a little bit ahead of the operation and the oversight and the governance structures that exist. And that's probably, the one area that we would have to keep an eye on as the risk doesn't disappear, it just transforms and moves around. And I think that's what you're trying to do, is to try and anticipate that, as we all are. I mean, some people will do it to make a profit. Vanguard wants to have that anticipation just to know what the market might end up doing for our investors as shareholders. So.
Okay. All right. So, I think that what we had intended to pursue was to see whether there were commonalities, and I think we've seen the commonalities, which is there's some very, very high level, the principles are kind of the same, but it's got to fit to the business. So in terms of trying for us to kind of hear about whether there are shared, practices or something like that, I don't think we're going to go into that. And that being the case, I'm going to open it to other, final comments or thoughts that people want to put on the record. But otherwise, I think we'll just call it short. I think this has been, I hope you don't take it wrong, because it's been amazingly helpful to get, these last few minutes have been very helpful to us to understand and to digest it that way. It's just that it's so productive, so helpful, and I don't think we need to explore the places where we were going. So thank you for that. Is any of the,
if I could just say one thing, I feel like in listening to everybody's comments, I think we presented you with a common theme. I feel a little bit badly because I don't think we've been totally helpful in terms of delivering you an answer, right? And what I want to impress upon you is that these are things that allocators to hedge funds struggle with every day, right? If we could develop, if Jay and I could develop a uniform code of risk management for the 1,600 probably hedge funds between our two firms we look at every year, I wouldn't need a team of 50 analysts, right? I would manage my operating expenses very differently, right? So I guess what I want to impress upon you is we look for these not easy answers. We look for these uniform answers too, and commonalities and themes. And if we could find them and manage our businesses more efficiently by utilizing them, we would. Instead, what we found is industry complexity proliferates, and the level of sophistication your firm has to develop to anticipate that industry complexity as it proliferates, it just compounds. And one of the neat things, frankly, about banks opening up some space for hedge funds is everybody around this table is looking at new investment opportunities, and we're saying, okay, the banks used to do it this way. Maybe that's too risky for my investor base, so I'm going to change it and do it this way instead, in a way that Halcyon can sell to Mesirow with a specific volatility and return profile that we find interesting and appropriate for our investors. But at the end of the day, our investor base is 95% institutional. That means pension plans. The ultimate end beneficiary of what we do is someone who has retirement needs and who has right now way too much long-only equity or long-only bond exposure in their portfolios. And these opportunities that are rolling off bank balance sheets are actually, from our perspective, an extremely important way for us to deliver diversification and lower volatility at the end of the day to that end investor group so that they can realize their goals. So we've talked about innovation and kind of not wanting to dampen down innovation. It has a real impact not only on new and underlying startup hedge fund managers that we all want to see grow so that the industry grows and we can do interesting things, but it also, and this is a real concern for us, it also has an impact on our ability to deliver that diversified return stream to that end investor group that desperately needs it and frankly cannot source it on their own through their 401ks and things like that. So we feel very passionately about this, and we're very concerned about it, and we appreciate your calling this roundtable and the attention of everyone here to this issue, because we think it's extremely important, and we appreciate being invited to participate. So,
Greg, would you say that your biggest risk among your portfolios is valuation?
No, I don't think of it that way. No.
I get that a lot from investors, that that the thing that they're concerned about, not with us, but across their investments is is valuation. And I think that's something that the industry has really moved on over the past few years. And in swaps, it's not really a concern, given that you have two parties that are negotiating and valuing together. So I'd say that I found that that's the biggest risk factor that investors are concerned about, and that there's been a tremendous amount of progress on that front. As people mentioned, third-party administrators and all the other tools.
Yeah, I was just going to chime in to kind of echo what Greg was saying, but from a trading funds perspective, which is that the same idea that there is no simple preset solution from a fund-to-fund perspective. From sitting in a trading fund, whether it's the GC, CCO, whatever, any of the risk control functions, this is a large part of what we live and breathe every day. We spend a lot of time focused on it, and to some extent, I actually think that there are, like we were saying before, best practices either imposed by counterparties or industry participants, or just what's been fairly established. But there's also a very lively and continuous flow of information, especially on the operational side. People in our positions are going to conferences all the time. They're getting alerts from their law firms. They're using compliance consultants. They're using a lot of resources. Frankly, there are a lot of peer groups just to we challenge each other. We challenge ourselves. We find out what are other people doing. Should we be doing the same thing? And we share with a view to enabling all of us to do our jobs better, especially on the operational side. I feel that we all improve collectively. That's actually uniquely and much more available to us on the operational side than it is on the investment side, appropriately so. So I similarly don't want you to have this impression that there is any objection to best practices. It's more that the way we're living right now, I should speak for myself, I believe that the industry is is acting in a way to try to keep what they think to be best practices on such a fluid level that an attempt to formalize that, whether it's from a regulator or a trade group or otherwise, would actually be counterproductive.
I just have one more thought, not to belabor it, is, you mentioned valuation. I think that's been a hot topic for a while. I think the industry's gotten better at doing it. Honestly, my biggest concern, if I had to identify one, is hedge funds keeping up with the continual compliance changes going on, not just in the US, but in Europe and Asia. It's very hard. They don't all coincide with one another. You need different people with different expertise. And, failure. Usually if there's a valuation issue, they can be big, but usually it's something small, and it's a small adjustment to NAV. They got to go back and restate. If you mess up from a compliance standpoint, that could be the end of your business, right? Because investors like myself, depending upon how significant it is, may say, you know what, not worth the risk, don't want to play with those guys anymore. So that's what has us most concerned, among the tier.
And I would just add to risk, sort of paraphrasing what Todd had said. There's an old saying that the best risk management program is to simply do no business, right? We've all lived with a lot of unintended consequences of some well-intended rules from Dodd-Frank and otherwise. And when whatever the rule is, there's always something that it hits that no one thought about, and to try to, as Dove said, find a formula for the appropriate risk management formula or tools or policies or whatever. It's going to have those same consequences. And, it's sort of echoing what James said. We in the trading side look every day for what is going on in Europe and what is going on here and what is going on there and what are we missing. So to put a new set of rules around risk management that would by definition not really fit any business would, I think, probably just has the potential to do more harm than good.
It does, and it has the potential over time to focus you on the wrong things. If you're focused on these prescriptive items that a regulator has given us, then maybe we're not as forward-looking as we are now, thinking about what are the risks that are immediately facing us, what's coming down the pike a year from now. So giving us that flexibility is certainly important. And with resources drained as they are on the compliance and legal side, which is a lot of the groups that harness some of the operational risk, at least in firms, that could be detrimental.
I'm not sure that adding, I've listened to all the comments and I sort of was a little quiet on this issue and I was thinking about what everybody said. I'm not sure that there aren't some, I think we sort of understand there's some sort of sound, I wouldn't call them best, but I would call them sound practice kind of, mosaic out there. And I'm not sure that if there were a rule or some restatement of some sort, I'm not sure it's going to be caught by anybody who isn't already observing this mosaic kind of way of doing it. I'm just not sure what would be accomplished. I'm throwing it out there. I'm not saying yes or no, but and I'm trying to think about it as you are apparently. Clearly, I'm just not sure it accomplishes anything.
I think maybe another comment would be where do we see, in our view of risk management, where do we see regulations helping our firm? And I think a smart regulation with a smart regulator is generally something they would appreciate. Things like oversight of intermediaries. When we're trading, futures, one of the things we do like is that there is some oversight there. Oversight of market infrastructure is another key area. So sort of the hubs of the infrastructure that we all work in, this ecosystem that we're all living together in, to the degree that we can get good sort of risk-based regulation of those entities and based on what function they perform in the market, we're all better off. But sometimes pushing those out to the endpoints, which maybe a mutual fund is kind of an endpoint, even though the shareholders are there, makes it a little bit more complicated. So I think new instruments and complexity, reviewing them. Ultimately, I agree. measuring risk appropriately and making sure you get compensated for that risk is the goal of our financial markets. So I think we're all on the same page that it's not to eliminate the risk management piece.
To piggyback on Steve's Seinfeld references, since we're airing grievances, the biggest, I think, factual issue that regulators sometimes don't understand is, what we're asked about, all the risk reporting we have to do, FATCA and all this, and they say, don't worry about it. It's just coming to us. I'll be damned if these guys aren't going to ask me for it. Whatever I produce to you, my investors are going to ask for. So, to say that if we add new reporting or new disclosure and it's just going to the government, that's not the case. We have to hire people to make sure that it makes sense and to explain it to the investors who are going to ask for the documentation that we give to you.
And I would just add from a disclosure standpoint, the disclosure documents, both the CTA disclosure document and the fund disclosure documents, are very good tools for disclosure of the risks that we all face and the risks in our business. We talk about extensively about market risk, counterparty risk, conflicts of interest. And so, from a disclosure standpoint, there is already a tremendous amount on it.
If utilized appropriately. I was going to say, you guys do good disclosure documents. I have reviewed many that are not quite as robust.
All right. Well, we thank you very, very much. Super helpful. Really appreciate it and appreciate your expert advice. Thank you so much. Thank you.